We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
I'm Eric Schatzker. Join me for my front row conversation with Causeway Capital co-founder and CEO Sarah Ketterer.
We're not value investors, we're valuation investors. Valuation is at the heart of everything we do. So if valuation becomes disconnected or de-emphasized, less important, that would be tough.
Catch the full front row interview with Sarah Ketterer this weekend on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This cannot be open season for hackers who can make money off of a threat, even if they don't go as far as crippling the entity that as with Colonial, they did not.
Speaker Pelosi there from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramovich will be back with us next Monday. From New York City, here's the price action. Equity futures up 24 on the S&P 500. We advance around about 0.6%. In a bond market a bid, yields in a couple of basis points on 10s to 163.35. Euro dollar, firmer euro, weaker dollar actually through all of G10. Yeah. Euro dollar 121.09. And Tom, just briefly, crude firmer, higher. Yeah. We're up 0.8% on WTI, 64.33.
Commodities give it back a little bit. I would note also, folks, Bitcoin was some stability after the fireworks yesterday. Right now on Israel, Emily Wilkins joins us, Bloomberg government reporter. And just to move the map from the southwest up north, Emily Wilkins, we can speak of Gaza and what we've all learned in the last 12 hours. Literally, folks, it's moving that fast. The Washington Post uses the phrase, as all-out war looms this morning. Then we move up to what clearly is serious issue between the 21% of Arabs in Israel on the streets of Lod, Tel Aviv, and the rest, the unrest within domestic Israel. And percolating as well, Emily Wilkins, is the northern border and the Hezbollah response. What have you observed beside the bromides from the president yesterday? What is the dynamic on Capitol Hill? What have we learned from the quiet of the Pentagon?
So at this point, a lot of the response is coming from President Biden, as you rightly point out. Yesterday, he defended the Israeli government's response to the Palestinian rocket attacks, saying that he had not seen a significant overreaction at this point. You have heard some members of Congress go ahead and speak up on this. At this point, you're not seeing any sort of major action from Congress on this particular point. I think to a certain extent, they are looking to the White House, seeing how, if and how President Biden will move here and if there's a role for them to play.
From where you sit, and I know you're a real student of this, what is the linkage of the Trump administration and the actions they took with Israel to what we pick up with the Biden administration? I really haven't seen a good treatment on that. What is the dynamic from the Trump Jerusalem embassy discussion over to where we are right now?
So You're right. I mean, President Trump made some big moves there that were very popular among his supporters, moving the embassy to Jerusalem. I mean, at this point, that's not something that President Biden has gone back in and touched. You know, it's interesting. You saw President Biden, I think, for the most part, really try to pivot a bit away from the Middle East, try and focus more on China, say, hey, this is where our attention should be. This is where the sort of major threat is right now. But obviously with what you are seeing, the escalation of this fighting and how much we're seeing, it's going to be dragging the president's attention back to the Middle East. I mean, it's such a contentious topic here in Washington. There's no way that he can really avoid this one or sort of turn a blind eye as these attacks continue to escalate.
We've got to get to the Sunday talk shows, and of course you'll hear those on Bloomberg Radio in the afternoon. That's proven very popular for us. John Farrow, there's the domestic issues as well.
There are, and there are many domestic issues right now. Emily, let's talk about a couple of them. The Colonial Pipeline, the ransom, the hijacking, the money they asked for, whatever you want to call it, they got paid. How important is that?
To a certain extent, it shows that it worked, right? They wanted $5 million. That's the amount that Bloomberg has reported that they asked for and that they paid. They were able to get that amount. And as you saw Speaker Pelosi sort of point out just a few in the clip that you played just a few minutes ago, that is a concern for her, as it is a concern for a number of members of Congress. You know, when I speak to members of Congress about this, I've asked a lot of them, were you surprised by this attack? And almost everyone has told me no, that they knew that there were weaknesses within the system. They know that this is an area that the U.S. is behind on and needs to catch up on. And so now I think one of the big questions is, are we going to see President Biden's infrastructure plan include cybersecurity infrastructure, which is not in there right now, include something on pipelines and oil, also not in there right now?
Yep.
Is Congress going to see that as a big enough priority that they might cut other things out of President Biden's plan to make sure that they are addressing this clear weakness in the U.S.'s security system?
Well, Emily, let's go there. Did the Republicans push for that this week in the talks they had with the president?
I mean, the Republicans and the president, they're still in such early negotiations at this point. It's unclear if they are going to be getting to the point where they do have a bill. This is something that has definitely come up in Capitol Hill, in the White House, in discussions. But I think there are still some very big questions about if a bill is actually possible. One of the hugest sticking points you're seeing is everyone says they want to pay for an infrastructure bill. How do you do that? Well, the Biden administration has this tax plan. Republicans have solidly said, we're not doing that. We're not making changes to what we did for taxes in 2017. That's a real sticking point here. And even though we are seeing a lot of meetings and negotiations, there's not really a clear path forward on how that one gets solved.
To that word negotiations, are there actual negotiations? Are we really getting down there, or when does that await for? Is that a Labor Day reality, before or after?
From the individuals in Congress who I've spoken with, everyone's pretty tentatively optimistic at this point. They say that, yes, these negotiations, they're not just window dressing, they're real, that the White House is actually doing the outreach that they need to talk to Republicans on these particular issues. And I mean, to a certain extent, you know, it is going to be hard for President Biden to keep his 50 Democrats together, particularly with what you've seen in the last week with the inflation, with the job numbers. And so there is sort of an incentive to try to carve something out with Republicans here on infrastructure, that's sort of the roads, bridges, and then, of course, there's debate about whether Democrats will need to go it alone on other items.
Emily, thank you. Enjoy the weekend. It's good to catch up. Emily Wilkins there, Bloomberg government reporter down in D.C. Tom, this was always going to be the harder bill to seal, the harder set of negotiations to get done.
Yeah, it is. And the policy here, John, is simple. As a Republican state, a more focused infrastructure bill out to some form of social infrastructure, if you will. And that is an ancient American political debate. That's not unique to the moment, John. That really goes back a long time. I'll give you just the one answer. And for our younger people watching and listening, this may be a surprise. But the interstate highway system with Dwight Eisenhower and the Republicans blocking it really was affected by Democrats. I mean, that's the lore of the 1950s. Why is this any different?
Are you prepared to say the policy push has stalled yet?
I'm not there yet, but boy, did we waltz closer this week.
Yeah,
no
you
question.
think so?
Yeah, I'm not there yet. That's a good question, and I'm unprepared to answer it on a Friday because, John, you left me. You're in the room with me, and I'm so lonely right now. I'm back in my.
What do you prefer? What are you more comfortable with?
What am I more comfortable with Lisa returning?
Do you still? I'll be more comfortable with that too.
Yeah.
Do you feel uncomfortable with people in the same room as you?
It's weird. No, seriously. Okay, coming out of the pandemic,
yeah, I'm with
you. We had some people
it's
over.
Been more than a year
we had
since
some people over the other
night
and
did this.
For the first time in a year, we had people over to the Manse the other night.
How'd it feel?
It was strange.
Yeah.
It was really, really serious. I mean, I'm sure everybody watching and listening is feeling they all got drunk, but hey,
well,
you know.
That's what happens when you go around Kazakhin. You have a drink. I'm familiar with that. I'm very familiar with that. Your equity market up 25 on the S&P 500. We advanced 0.6%. Coming into Friday, down 2.84%. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Have you ever thought of bottling your happiness? And you know, you could make a lot of money if you bottled your happiness.
Yeah, you know what it is? It's just gratefulness. I should have died in that field in Iraq.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on Bloomberg TV, and here's the price action right now. Equity futures positive about 25, call it 26 points on the S&P. We advance after the biggest one week loss coming into Friday. since the start of January, since the start of the year. Equities up 0.6%, the NASDAQ up around about 1 full percentage point. Is the rotation stalling? Is there more to go? Laurie Calvasino of RBC Tam and Bloomberg TV recently, there's more runway for this rotation to continue. Many of you share that view, I know. If we switch up the board and get to the bond market, we have seen a huge trading range over the last week or so. I say huge, 24 basis points to be precise. Last Friday, intraday at the low, 146. Intraday at the high yesterday, 170. Right now, 163.69. We come in about 2 basis points on 10s, on 30s, down about 3. So that's the bond market in the United States. Let's get to the bond market on the other side of the Atlantic, in the south of Europe, in Italy. Your 10-year.
Look at that.
At the lows of the year in February, south of 50 basis points. Now north of 100 at 1.084%. And that repricing, Tom, particularly over the last month, gets your attention, gets my attention, gets a lot of people's attention, and I'm sure it gets the ECB's attention as well.
In Italy, of course, about 1/3 back to pandemic yield. They're getting back to autumn, early autumn of last year, a little bit different trajectory than what we see in Germany. Again, for the pros out there, the German 10-year yield negative 0.13%. That is remarkable this week. John Farrow and I wanted to stop the show on a Friday and get away from the math. We'll do the math at 8:30 with retail sales and all that, and talk about, without question, the social essay of the recent, say, 10 days or 2 days. No doubt it's from Carl Tannenbaum. He is with Northern Trust of Chicago, selected parchments out of the University of Chicago in his leadership with the National Association for Business Economics. Carl Tannenbaum, your essay on class struggle jumped out of the screen. What is different, and this comes from Chicago folks, and everybody knows Upton Sinclair, what is the difference in the class struggle now that you see from Chicago than it was pre-pandemic?
Well, Tom, good morning. I'm glad that you're reading those sorts of things. We did do math in grade school, and a lot of young people need to do math in grade school now, as the article focused on. Really, school is at the center of a lot of things economically. Certainly over the longer term, we're training people there. But in the present day, the fact that schools are still largely closed, almost half of the schools in the United States remain closed to in-person learning. That has a ripple effect through communities and through families that is playing itself out really in the labor markets today. We do have a number of parents who are just not comfortably able to get back to accept those job offers that seem to be proliferating in the service sector, and may choose to wait until after the summer holiday is over before they make themselves fully available for the labor markets ahead. So at so many levels over such a long period of time, getting schools reopened is a very important thing.
Carl, do you see a change in the federal-state nexus of budgeting for childcare, for schools, for the social economics of a nation? Or with the pandemic, is it just a one-off and we're going to go back to the budget structure that we had pre-pandemic? Can there actually be a shift to a more federal structure of service to mothers, to children, to schools?
That will be for the Congress to debate over the coming months, Tom. I will say that we are behind other developed countries in the structure of our child care system, which is, as school is, essential to parents' ability to offer themselves to the labor force, and also for parents who are in the labor force to continue upward on their employment trajectories, accumulating skills, remaining adaptable, and remaining the innovators that we're going to need for economic growth to reach the levels that we want. Right now, it's a bit of a patchwork of centers and in-home care, very poorly organized. And if we could just bring a little bit of sense to it, I do think that there would be returns economically and also socially.
I mean, John Farrow, I look at OECD data, stuff Catherine Mann did when she was there before Citigroup. And John, even the United Kingdom's getting this better than we are, aren't they?
In terms of what, Tom? The entitlements?
Child care, school, just
it's a very different system.
Yeah, but I mean, John, from where you sit, seriously, should we shift more towards a European model?
I don't think it's for me to decide. I think it's the electorate to decide. And when I look at the politics in America right now, Tom, it's still incredibly divided. And what's interesting for me is that the president wants to reflect the needs and demands of society and the electorate, but they have very skinny margins in Congress to be making huge moves. You and I have been talking about this. Can you make that move towards a European model? It's not for me to sit here and advocate for that. Can you make that move towards a European model with the margins that they have in Congress?
Well, Carl, do you see that?
I think it's going to be very difficult, to be honest with you, because in addition to what was just mentioned, right now education is the province of the states, and the states finance it in a variety of different ways. Unfortunately, what that leads to is some of the inequality of opportunity and really asymmetric quality of education across the country. And we really can't afford to lose a lot of minds if we're going to remain at the forefront of the global economy. So I do think whether it's federal standards or perhaps some funding that moves us forward to a better place, I think that deserves careful consideration.
Carl, these are huge societal issues. The data of the morning is retail sales, and there's been a big conversation about where the savings rate is in America and how much it needs to come down. Now, Carl, I'd love your opinion on who holds that money, where those savings are right now, and to what degree you expect them to be deployed in the year ahead.
The estimates are that we have about $2.5 trillion of excess savings waiting to be spent. As you've hinted, though, a lot of that is concentrated in some of the higher income households who have a lower propensity to spend. That said, we are transitioning from a spring bloom to a summer boom, I think, in spending, as things that were denied to us, entertainment, travel, restaurants, are now open, and we have pent-up demand intersecting with pent-up saving with a reopening, and that's creating quite an economic energy here in the United States. The chances are that the second quarter could be well over 10% in terms of real growth, and we'll go onward from there.
Well, we'll go onward from there. Come on, Carl, you are expert at this. You know, you've led the nation on statistics here for years, Diane Swank and others at NABE. What's your Q3, Q4 look like to the 100th decimal point?
Well, they say that an economist with a sense of humor carries their forecast out to 2 decimal points, but I know that our second quarter is over 10, our third quarter is over 8, our fourth quarter is in the range of about 7, adding up to the best GDP year that we've had in the United States since the early 1950s.
I mean, John, there's the most optimistic set I've heard from Carl Tannenbaum. 10, 8, 7. Do the math, John, 9 months.
Well, I'm trying to work out into 22, into 23, the degree of deceleration we might get to, Tom. I think you and I have been talking about that. Carl is now as well. Carl, just put some numbers on this, going out beyond just what's in front of us right now, into 22, into 23, what you think the shape of this cycle actually looks like, or whether it's too premature to extrapolate things out too far too quickly.
Now, obviously, I think the momentum is going to dissipate as we move into 2022. I think our full year growth number for 22 is in the 2.5 range, so a little bit closer to trend growth. The fiscal impulse, if you will, of all of the stimulus is probably going to be wearing off, even if we pass some of the new Biden plan. That's a 15-year window and not a 12 to 18-month window. In addition to which, you'll have all of the energy released from the pent-up demand and largely sated by then. A few sectors may be holdouts, but I think you're going to get back to a more normal level. And that's really the challenge for policymakers is, are you creating a boom-bust cycle here? Have you laid the groundwork for a short surge or something that's a bit more durable? And that's where I think, going back to the comments on Congress, what can we do and should we do to make sure that these next few quarters of success are not the only quarters of success?
Carl, to jump in, 2.5, 2022 puts you well below consensus. In our survey right now on the terminal, on the Bloomberg ECFC Go, for any subscribers out there, 4% is the GDP call for 2022. What brings you down to 2.5, Carl?
I think that there's, again, going to be a reduced fiscal impulse and sated demand. I also think, and despite what Jay Powell is telling us, that they're likely to start tapering their balance sheet program early in 2022, simply because there's too much liquidity out there, and it's finding its ways into places that may risk financial instability.
Carl Tannenbaum of Northern Trust, the chief economist. Tom, do you want to pick up on that? That is severe, serious deceleration from this year to next, if you think we drop back down to trend that quickly, back to 2.5.
With great respect for Carl's leadership here on the mathiness of all this, John, as he said earlier, he doesn't have a clue. He's modeling 10, 8, 7. But, John, we're making this up as we go. Remember Morgan Stanley? Ellen Zentner came out with like 9, 10 or whatever, and then we were off a cliff in August, and even they've amended that.
Well, Tom, for the bond market, this kind of thing matters, for the equity market as well. Too, if what you're modeling is for this to continue somewhat, I don't think anyone expects a repeat of 21 and 22, but that D word, deceleration, to that degree, I think would be that would be a shock for a lot of people.
It's why I'm triple leveraged all cash.
That's where you stand in cash.
That's where I stand. John, I found a chart while you were talking to Mr. Tannenbaum. I went to 2019 OECD, London, United Kingdom, and Australia, right smack dab in the middle. No surprise, Iceland, Sweden, Norway, France, way up top on child care as a percent of GDP. We're killing it with Romania and Turkey.
What do you want me to say?
There's nothing to say. It's an outrage. We're living this, folks, every day. For those of you on radio and TV, everybody's living this in their own way. On soap opera, you know, nannies, au pairs, childcare, medical, the whole thing. It permeates American society.
Do you think we saw evidence of that in the labour market in the last week?
I think we did. Again, as you and I talked about.
You think there was evidence of that in the jobs report, in the participation rate?
Yeah, we did. Yeah, there's no question about that. Pros, not you or me, but pros have said clearly there's a female dynamic that we're seeing in the recovery.
Yeah.
But I would go to what we saw yesterday, and this is, we didn't have time to go to it with Carl Tannenbaum. Maybe we'll do it with Lou Alexander. To me, the big numbers yesterday were 75,000 plus 10,000 at McDonald's own restaurants.
Tom, I won't advocate for a political position. I'll always try and avoid that. I know we make mistakes sometimes and we get seduced by the idea that people care about our personal thoughts. But when you think about Europe and the rigidities of the labour market and the amount of reforms that have had to have been done over the last 10 years because it just wasn't flexible enough in places like Italy, in places like Spain, there's two extremes to this. Just remember that. And I don't think anyone has the perfect model.
If we provide more appropriate child care to get us to the middle tendency, do we risk becoming like the Italian labor market? I would say not.
Not for me to say that we do, but as you know, Tom, in terms of politics, once you start something, you don't stop there. Usually it progresses and moves on. Tom, it's not for me to say anything about what I think. I think there's evidence in the data.
Lost.
Wait, in a participation rate, the female participation rate was down. Most people assume that was because of a lack of childcare in this country. It's not my political view. That's just the economics data speaking for itself.
So, John, are you saying the bartender at the Metropole in Venice, that's lifetime employment?
I'm saying if they're fully employed and they're on the staff, that it's difficult to release that member of staff compared to, say, the United States of America. Okay?
Yeah, okay.
Did we get past that okay? 41.32 on the S&P 500.
Can you come back in the room here? Come on.
Maybe. I'll think about it in the next hour. Let's have a little look.
You know.
I'll have a little look.
Have your people talk to my people.
Let's try and work something out. Futures up 0.6%. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Israeli warplanes have now been joined by ground forces in their attack on Hamas targets in the Gaza Strip. Tanks and artillery are firing into Gaza from the Israeli side of the border. Meanwhile, Hamas militants continued launching rockets into Israel. So far, more than 100 people have been killed in Gaza and 7 in Israel. The CDC is signaling a broad return to everyday life in the U.S. The agency says fully vaccinated Americans can get rid of their masks in most settings, even indoors or in large groups. The Biden administration is making clear that the guidance is a further incentive for people to get the vaccination. And a long-awaited quarantine-free travel agreement between Hong Kong and Singapore is in doubt. It was due to begin May 26th, but now it may not go ahead because of a rise in coronavirus cases in Singapore. The so-called travel bubble originally was set to begin last November. And Kansas City Southern will accept a revised $33.6 billion takeover from Canadian National Railway. Still, the American Railroad will give its other suitor, Canadian Pacific, until May 21st to come up with a higher bid. At stake is a rail network that stretches across Canada, the U.S., and Mexico. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
If there's someone with a mask, you see them, please treat them with kindness and respect. We've had too much conflict, too much bitterness, too much anger, too much politicization of this issue about wearing masks. Let's put it to rest. Let's remember, we're all Americans.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz will be back with us on Monday. Here's your price action this Friday. We're shaping up as follows this morning. Equity futures are up 0.6%, advancing about 24 points. Into the bond market with yields lower by a couple of basis points to 163.52. In foreign exchange, the euro firm, a dollar weaker through much of G10, through much of this morning. Euro dollar 121.08. And Tom, just to round things out, up 0.9% on WTI, $64 and about 40 cents.
Yeah, it's an interesting data churn here, and we'll go to 8:30 in retail sales today and see how that moves the markets on this Friday. This is bar none an important conversation, and ever more important from what we heard from CDC yesterday. Gigi Granville is a real deal with a PhD from Johns Hopkins in T-cell receptor work. Think Catherine Zeta-Jones. It's about zeta proteins and something called CD3 zeta change and the rest of it. Look at the Wikipedia on T-cell receptors, and you'll go, oh. She joins us now from the Center for Health Security at Johns Hopkins. Dr. Granville, I want to cut to the chase. I'm going to be in a restaurant. My mask is off. The place is again packed as we're all getting back to. How do I know that somebody's not vaccinated? And what does it mean within the immunology in that restaurant?
Right. Yeah, you don't know that everybody is vaccinated. And by fully vaccinated, we mean 2 weeks after your final dose. And you could be exposed if community transmission is high. It's just that with your vaccine, you're able to fight that off.
Okay, you're able to fight it off, but the whole family doesn't have vaccines. Somebody under 12, maybe an infant. Are you kidding me? On a game theory basis, with all of your expertise in T-cell receptors, your work at Sloan Kettering, great. Is this actually going to work?
I am not going to take my unvaccinated 11-year-old to inside a restaurant at this time. That is absolutely the case. But I have less concerns about myself and my 13-year-old, who I took to get vaccinated yesterday, once he's fully vaccinated. So, yeah, I mean, people have to make decisions based on their own circumstances. It's just that it'll be safer for the people who are in the restaurant, who are working the restaurant, if they're vaccinated for sure. And it'll be safer for everyone who gets a vaccine.
This is a really difficult decision for parents right now, Doctor. They're trying to work out to what degree their children are at risk from this virus. Do we have better answers now?
Well, I mean, children do get sick, and people have, I mean, just not in comparison to adults. Adults have had much worse outcomes when it comes to COVID than kids. But if you look at the numbers, about 22 million children have gotten sick from COVID. And if you look at the rates of hospitalization, it's worse than an H1N1 flu in 2009 for kids. So it's, by comparison, it's not as bad as adults, but kids do get sick. So They still need to take precautions, and if they're 12 or over, they really should be vaccinated.
Gigi, if they're 12 or under, how long does this go on for the children of this country or the children around the world?
Believe me, I'm waiting too. I think everyone thinks that maybe August, September that we'll start opening up to being able to vaccinate younger kids.
I mean, look, Axios just published moments ago, Mike Allen doing a great job over there. And Dr. Granville, you know, they take the spin of what we're doing with CDC and call it Liberation Day. Is it?
I didn't find wearing a mask to be all that inconvenient, and I saw it as a way of being courteous to other people, but it has become obviously a very polarizing issue. So.
Okay, let's go to the realities here of what we see in the hospitals as well. How will this change for the essential workers, you know, still courageous in the hospitals?
Yeah, so I mean, I think hopefully the community transmission will go down. So hopefully they will have more, more resources to attend to the patients they have. I think that we need to still do more to bring vaccine to people. There are a lot of essential workers, not in the hospital, but in other places who can't afford to take the time off to be able to get vaccinated. So we still have access issues in this country that we need to address.
Doctor, appreciate your time this morning. Thank you. It's good to see you. Dr. Gigi Granville, we really appreciate your perspective. Johns Hopkins Center for the Health Security Senior Scholar. Tom, just some of the complications right now around all of this going forward from here. For a lot of people just eager to get on with their lives, I think they can try and reclaim their lives now. Get rid of the mask, they've been vaccinated, move on. But corporations need to respond, and there's still a lot of work needs to be done.
We're going to celebrate this like everyone else. It's exciting. And John, you tell me, because you're down in the hip part of New York, my idea of deeper New York is to get below 72nd Street. You know, it's a sheltered life.
I can tell you downtown's busy on a weekend.
It's like, and it's giddy. It's almost giddy. You know, it's like we're all back, and that's great. And yet Dr. Granville there's talking about some serious issues.
There is a degree of excitement, Tom, but I don't think we should forget that there's going to be a long hangover from all of this, and mental health issues are going to be top of the pile, I think. Just remember, Tom, for a lot of people, they won't be able to adapt that quickly because of what's happened over the last year, the last 12 months. They won't be able to move on that fast.
It's weekend by weekend as well. I want to get back to the markets, John. I got to look at NASDAQ up 1% from the peak here 8 days ago. I'm using 8 days as a real marker, folks, here before the jobs report. NASDAQ negative 4.2% on futures. And the VIX, John, coming back 27 down to a 21 handle. We're like halfway-ish, 2/3 back.
S&P doing better this morning, up 0.6% to 4132, up about 25 points. What are we looking at? The biggest weekly drop since January, the start of the year? Coming back 2-3 percentage points.
Let me ask you this. It's not a question I'd ask you if we were in the same room together, but I can do it from a distance. John,
there's a glass wall between us.
Yeah, yes. Do you think that the economists will recalibrate their GDP call after this retail report?
I think they will. I think they're going to have to wait.
I think they do, because it's a huge part of the economy.
No, I agree with that, but I just don't think you can make a year's call off one single data point.
No, but you can tweak this quarter and get into Q3.
You think you bring it in a little bit?
Yeah, I think I don't know. We got to see what retail sales
That's what I'm trying to gauge by what you mean by this. Do you think people are too bullish right now in the year ahead, given what we've seen in the data?
I don't have an opinion on that, but I'm thinking we've got to pay attention through Friday night when we're having a beverage of our choice into the weekends for GDP changes from the major houses.
Where are we going tonight? What's the plan?
I'm thinking artichoke ravioli.
Artichoke ravioli.
The helicopter's free, so I think I'll get that.
Is that what you like?
Yeah.
What's the beverage of choice this evening?
Haven't decided yet.
No.
Francine did a beautiful thing on champagne in London. I was going to go.
I saw that. That was a great interview.
It was a great interview, and they didn't mention my favorite, Dutz. Champagne.
What is that? I've never heard of that.
It's a French champagne. It's Madonna's favorite. Madonna gave it to me.
Madonna gave it to you?
Yeah.
Does she still live on the Upper East Side?
Yes, she does. She's in school and all that. She's hanging.
Retail sales.
Dutz.
About an hour and 35 minutes away.
You should try it, John.
I don't think I'm ever allowed back in that room again.
Dutz.
I've missed you.
We'll have to see.
That was fun, wasn't it? For 10 minutes. Equities up 0.6 to 1%. On the S&P 500. Your bond market was 63.52. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There are structural changes going on in an economy. It becomes very difficult for economists to forecast with any degree of accuracy.
No, we're not done with the adjustment to a shock. Big shock down, big shock up.
The equity market is telling you that there are inflation fears all over the place for investors.
The risk of that is rising, but we should be a little careful about jumping to extreme conclusions.
The Fed says, don't worry about it. We're not concerned. This is a new paradigm.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz will be back with us on Monday. Your equity market up 0.5% on the S&P 500. We advance on the NASDAQ by 0.9%. It's a snapback, and any dips are being bought. Once again, Tom, that's the argument. Citigroup's Robert Buckland saying it's too early to give up on the recovery trade. Buy into any short-term dip.
No,
is that what we just got?
Yeah, that's one view, and I'll be honest, that's the zeitgeist you and I heard this week. We saw some resets of SPX up higher. There's a few people under 4,000 for year end. You know, everybody's got an opinion, John. Here's my opinion. Most important equity strategy headlines of the week came from Amazon, McDonald's, Chipotle, and the rest of them.
Couldn't agree more.
Over rising wages. And again, as you know, I sound like a broken record, I'm not concentrating, John, because you're not sitting with me in the room.
I know.
But it's the number of bodies, 75,000, 10,000, 6,000, and frankly, for small business, 25 people they need to hire, they can't get them.
Most important data point of the week, job openings in America, I think, Tom. I know a lot of focus was on CPI, but that's at the epicenter of the conversation, isn't it? All-time highs on job openings in America at records since records began. You've got to attract the workers. You need the supply to meet the demand. Price needs to adjust.
Good morning, Paul Wilmot, Imperial College, a legend on drift, and it's real simple. The quantitative drift of claims, John, is beautiful, it's elegant, and it's a very constructive chart for America to a lesser claims statistic.
If things get better, they need to get much better. We are 90 minutes away from a retail sales print in America. Ahead of that, here's your price action on the S&P 500 up 24. We advanced to 41.31, up 0.6%. Into the bond market with yields coming in just a couple of basis points to 163.69 after a sneak peek of 170 in yesterday's session. We come all the way back down again. In the FX market, euro dollar weakness, the theme this morning. Euro dollar 121.11, up by 0.25%, and crude bouncing back with that dollar weakness. Crude 64.56, up a little more than 1%, Tom.
I should mention, John, I really studied this morning to see if the unrest in Israel, Gaza, even the rumors of the northern border of Israel, if it was affecting oil. I don't see it yet. I may be wrong on that. A pro may say you don't, but I looked at the Bloomberg. You know, you look at CO1 commodity, CL1 commodity. We got them all here, and I just don't see that dynamic right now on the Bloomberg terminal.
I don't see it either, Tom, but we will head down to D.C. in about 20 minutes to get a view from Washington on what is going on and how this administration will respond.
We'll have to see on that. And again, Emily Wilkins was quite good on that here in the last hour. John, we got a wonderful guest really here to drive forward. What do we do next?
Let's start with David Leibovitz, shall we? JP Morgan Asset Management Global Market Strategist. David, is it time to give up on the recovery trade? Have we got this one baked in?
So I do think that there's still room for the recovery and more cyclical and value-oriented trade to run here. We've done a lot of work on this, and our base case view is that we're going through a period where rates are consolidating, but there's likely another leg higher during the second half of this year. And so our base case view is that as the economy continues to open back up, as inflation expectations continue to move higher, that should support another leg in the recovery trade. But arguably, by the time you get to the end of 2022, or 2021 rather, slower growth is likely going to be coming into view, and that would support a rotation back into growth.
What kind of deceleration are you expecting going into next year? We just caught up with Northern Trust in the last hour, David, and he was talking about a move back to 2.5% in 2022. Let's be clear, that's out of consensus. Consensus is about 3, 4, 5% going into next year. David, what are you looking for?
So a lot of the forecasts are between 4 and 5%, and 2.5 feels a little bit low based on our expectations. You know, I do think we're going to get a pretty sizable infrastructure package later on this year, and while that is a longer duration spend and a fairly long burn, I do think that it helps prop up growth a little bit more in 2022 and arguably into 2023. So, you know, by our lights, we'd be more in the 3 to 4% range for growth next year, but then really decelerating back towards trend in 2023 and beyond. And I think that that's really the key issue for investors. You know, we're having this surge in economic activity right now, and that is filtering through to the profits of the companies that were hit the hardest. Trees don't grow to the sky, and it's not going to continue forevermore.
David, I loved your research, you know, where you talked about the inflation elephant. Let's drill down to that. And to me, the big change this week is not $15 an hour, but people whispering $16 and $17 an hour is the wage inflation elephant. And that gets me to something I've never framed before, which is I don't want to get gloomy here, folks, and say whip inflation now, Biden. But can I say a cost push Powell is something we may have to consider, where the Fed has to look at cost push inflation?
I think that it is a reasonable expectation, because you're really seeing two things go on right now. You know, on the one hand, you're seeing commodity prices. I know they've come off the boil a little bit, but input prices to the manufacturing process continue to move higher. And then you have this whole issue of wages. And, you know, it's really interesting because you look at earnings estimates for next year, people are looking for 15, 20% earnings growth on the back of what we think will be almost 50% earnings growth this year. But nobody's talking about the fact that profit margins are at their all-time highs. And if we do see the wage growth that I think is going to materialize, it's going to make inflation stickier, and it's going to be a problem.
This is a really huge issue, folks, because you take the wages and the issues and you go up the income statement to a better revenue with a boom. You go to a better nominal GDP. And David, the question really becomes, is inflation bad for stocks? Am I right that it's an ambiguous concept that we don't know?
I think that that's a fair assessment of it. You know, people talk about, well, you know, stocks can be okay if rates rise for the right reasons. I mean, what are the quote unquote right reasons? And so what I really think is most important here for the equity market is what the Fed is saying and what inflation expectations are doing. I would not fret about a very robust CPI print this past week. I would focus on the fact that inflation expectations were actually pretty well behaved in the aftermath of that. And that's part of why stocks have found their footing. Yes, we've pulled forward expectations for some Fed tightening, but still expectations are not that inflation is going to be a longer term problem. But if you see those expectations become unhinged, that's really when equities are going to begin to stumble.
Well, David, I think the question that Tom's bringing up, and I think is an important one, is the margin point. As labor pressures continue to build in America, we haven't really had this story for a long, long time in this country. And there are some companies that have managed to get away, I won't use the word exploit, but have gotten away by having access to a very cheap labor pool. David, can you say that's going to be the case any longer?
So I think it's not necessarily new news to anybody. Income has been flowing to capital rather than labor for the better part of a decade. And what I think you're seeing here, and it's a combination of a government that's a little bit more progressive in their thinking, and companies that recognize they need to incentivize workers to get off the couch and come back into the labor force. I do think we will see higher wages here. And John, we need to remember that it's very difficult to take a wage increase away. And so I do think that wage growth could be a little bit stickier. And again, margins are the big story for me when it comes to 2022.
Is there a sector preference in mind going into 22 with everything you've just said?
So I think you still want to lean into the financials. I think that there's a really positive story there about rising rates and furthermore, the ability to resume or accelerate buyback programs and increase dividends during the back half of this year. I also think that industrials continue to look quite interesting because arguably very robust growth in the United States should spill over into the rest of the world. And that more synchronized global growth story, I think, will have legs during the first part of 2022. But, it's really about owning growth and renting value, because at some point this reflation trade will run its course. And again, we'll be back in the environment that we were in for the better part of the post-GFC expansion.
Yeah, that's a really interesting concept of owning one and renting the other. Do you own or do you rent mid-cap, small cap?
So small cap, mid cap tends to be more correlated with value. I think that, the small cap trade is a little bit more of a rental right now. But my view is that mid caps, that's the sweet spot of the equity market. It's the companies that made it out of the small cap space. They haven't yet made it into the large cap space where we know inefficiency can become a problem. And so I'm kind of an all-weather mid cap guy. But I do think that the small cap trade may peter out at the same time as the value trade, early next year.
David, good to see you, as always. David Leibovitz there, JP Morgan Asset Management, global market strategist. What was that, Tom? Own growth, rent value.
Yeah, it's a huge concept here. It's the x-axis timeline. A lot of people in strategy talk about this as well. Doug Cass is particularly articulate on this. I don't have a view here, growth or value. It's not for us to say, John, but it's something that everybody watching and listening needs to understand. It's the durability of the trade. For example, with one stock, say Amazon, do you rent Amazon at a given point, or are you going to own it forever? That's the kind of decision.
Well, it's a cycle call, isn't it? The degree of deceleration you expect from this year to next. If you believe in the Northern Trust world, deceleration down to 2.5%, then David's point makes sense.
Yeah, this is really important, John. You bring up the heart of the matter, which is you have to use your economics to construct the cycle belief to get to what you do within the stock market is a simplistic idea, or across bonds, currencies, and commodities as well.
As simple as this: how scarce will growth be? And how willing will you be to pay up for it?
I will, John, I'm only saying this because you're in another room. If you were in the room with me, it would be too personal. I wouldn't want to do it.
We don't want to get personal,
There we go. Nice shot there, folks.
Is that what we want, this distance?
Yeah, we're really not.
We're going to maintain this all year.
That's a pretend shot, folks, just so you know. It's like Leon Cooperman with the Turks and Caicos behind him or whatever he's got. I'm actually at my house up north here, the summer place. But, John, what's important here to understand is my belief is corporations adapt and adjust. Every cycle, up and down, there's a misunderestimation about how executives adjust to the cards they're dealt.
Yep, and those corporations this morning, on a lighter note, have got to wake up and work out what they do with this mask mandate and the shift that we've seen. Dr. Fauci out on MSNBC in the previous 10 minutes saying the guidelines are a major step to a degree of normality.
Yeah, Dr. Fauci weighing in. I'm going to weigh in with McDonald's on 3rd Avenue where I'm scheduled to have lunch. I mean, what do? They need more help.
Are you making a Mars point or a Labour point?
Both. No, I think they're linked, John. That's the point.
I agree.
What do you miss Lisa so much you can't talk to me this morning?
I do miss Lisa. I'm looking forward to Lisa coming back.
You know what it is?
Talking about Mars,
you know what it is? We need a banner. For radio, the pendulum of inflation. We need the pendulum of inflation is where we are.
It's just
right now.
Jarring being in a room with you and then not being in a room with you.
We don't on radio. We don't miss Lisa, but it is the pendulum.
I do. Speak for yourself. Equities up 26 on the S&P. We advanced 0.6%.
Testy there this morning.
I think I'm being all right. I thought we were getting on okay.
Yeah, that's the
point. We've had a good week, haven't we?
You're doing just all right. That's all.
How much better do you want to get along?
I think, we could do the whole next hour in this room and probably get along.
In the same room?
Yeah, we need, a bouncer or two.
This is
Look, John, I just over the black eye that you gave me.
With the First Word News, I'm Rishka Gupta. The fighting between Israel and the Palestinians has taken a new turn. Israeli ground forces are now firing artillery at targets in the Gaza Strip. Israeli warplanes continued their own bombardment. Meanwhile, Hamas militants are still firing rockets into Israel. More than 100 Palestinians and 7 Israelis have been killed. The gasoline shortage in parts of the eastern and southeastern U.S. could drag on for a week or so. That's according to one of North America's biggest distributors. Andy Milton of Mansfield Energy says now that the Colonial Pipeline is back in business, the problem is a lack of trucks and drivers. They're needed to take gasoline and diesel from distribution hubs to gas stations. And Amazon is extending its hiring spree. It plans to hire 10,000 more people in the UK. By the end of the year, the world's largest online retailer will employ 55,000 people in Britain. The new jobs will be in corporate offices as well as in Amazon Web Services and operations. And Dogecoin jumped on renewed support from Tesla CEO Elon Musk. That adds to a volatile week for digital currencies that's been whipped up largely by Musk himself. Musk tweeted that he is working with Dogecoin developers to, quote, improve system transaction efficiency. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
I had a brief conversation with him yesterday. One of the things that I have seen thus far is that there has not been a significant overreaction. The question is how we get to a point where they get to a point where there is a significant reduction in the attacks, particularly the rocket attacks that are indiscriminately fired into population centers.
The first big foreign policy test for the President of the United States in his first term. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramovich will be back with us this coming Monday after the weekend. Tom, you take Monday off, don't you? You off next Monday?
Am I? I don't know.
You're getting some rest.
I don't check with my people.
Equities up 25. They'll let you know.
I don't know.
Up by 0.6%. In the bond market, yields coming in a couple of basis points on a 10-year to 164. She'll be back. In the commodity market, 64.64 on WTI, up by 1.28%. I know there's a bit of deal news that you want to focus on, Tom, so I'll bring the headlines.
It's deal news when it comes out at 8 p.m. at night and sort of slips through, and I missed it on the, folks, I'll be honest, I miss this. 2 Canadian railroads, Canadian Pacific and Canadian National, let me tell you, they are competitive, and they're going after down the Mississippi River, Kansas City Southern. It's been back and forth, a higher bid by Canadian National. Last night, John, KSU takes that offer, and Canadian Pacific has, I think they have enough time until the Montreal Canadiens get better to make a counter offer, but that's where it stands.
That might have been confusing for a lot of people, Tom, so I'll try and go through it and explain it just a little bit more succinctly, shall I? Just quickly.
Oh, please.
Kansas City Southern intends to accept a revised merger offer from Canadian National, but will give Canadian Pacific until May 21st to come up with a higher bid.
You nailed it. I mean, John.
Well, that's the work of Thomas Black and the team. I'm just reading their story.
I called up my railroad analyst, Luke Kawa at UBS, who said the difference is, he said the difference between the two railroads is like the difference between Labatt's and Molson's.
Okay.
That's what he said.
I'll take your word for that.
Yeah, he did. There's a nuance there in the beer. Let me bring in Ben Bain right now in Washington, not on Canadian railroads. But, Ben, I do want to bring it, it actually links in with the Illinois Railroad pickup by Canadian National the other, like a decade ago. And, Ben Bain, it's about the heartland of this nation. That's what those 2 Canadian railroads are arguing about, is the Mississippi River and the path down to Mexico. We forget about that too often. Does the heartland of this nation want an infrastructure bill?
I mean, if you look at what's going on right now in the heartland of this nation, there's barges lined up, can't pass the Mississippi River. I think there's a genuine sense, regardless of where the politics are, that the infrastructure in this country needs a revamp. It needs a refresh. So, and also people want jobs. And I think if you're talking about roads and bridges and highways, that tends to bring jobs.
To the Sunday talk shows, how much of social infrastructure can President Biden give up to appease the middle part of the Democratic Party and that heartland infrastructure need?
I mean, that's ultimately the question, right? He's defined, and the Democrats have defined infrastructure in a much broader way than Republicans have. Really at the heart of this argument, there's 2 things, I think. One is how it's going to get paid for, and we'll take that issue aside. And the other is, what is infrastructure? So the Republicans are saying, look, it's just roads, it's bridges, it's highways, and broadband. And the Democrats are saying, well, you also need to take care of older people, and you also need to do child care, things that they consider social infrastructure. It's going to be interesting. We're going to have to see how far, as you're saying, Tom, Biden and his team are willing to move to kind of strip out some of those things to get some Republican support.
Do we understand what the red lines for this administration actually are, Ben? And I understand that the concept of red lines is something that a lot of people don't appreciate. The Republicans have said their red line are the tax cuts in the Trump term, in the Trump administration. And I think we can all accept that probably is a red line for them. What's the red line for this administration?
I don't think we know yet. I think we're waiting to hear. I mean, after this week, you heard some optimism from Republicans after meeting with the president and his team. So there seems to be, at least publicly, the perception that's being put out there by the Republicans is that this administration is willing to move. They're willing to get rid of some of those potentially social infrastructure ideas, and maybe they're willing to strip things down. Maybe they're willing to look at different ways of funding this. We don't have a red line yet. That's probably part of the strategy here. Ultimately, this is the White House's plan, and they probably don't want to put all their cards on the table at this point. I suspect as this moves along, as we get into the summer months, as we kind of really see these talks heat up and the pressure to really get something done, potentially in a bipartisan way, we're going to see that red line. And when we do, there's going to be a moment where it's either going to have to be the Democrats pushing ahead, going through that reconciliation quirk where they have to just keep everyone, Joe Manchin, et cetera, on board and get it through that way, or if they're going to do something more bipartisan, which there does seem to be a genuine desire to do at this point.
I mentioned this to TK a little bit earlier this morning. Do you get the sense that things have stalled a little bit, Ben? Or is that too premature? Things just quieting down a little bit on various fronts?
I mean, I think they're quieting down a little bit on various fronts, but I think everything that we've seen this week in Washington is part of the broader conversation. You talk about the Colonial Pipeline. I mean, that's infrastructure. You're talking about barges stalled in the Mississippi River. Tom, you were talking about the heartland of this country. I mean, those are examples that infrastructure is in the conversation. This conversation has been going on for decades. It's no secret that this country's infrastructure is behind.
Ben, to cut to the chase here quickly, we're running out of time. Is this just about pork? We're going to spend June, July, August allocating the pork to make everybody happy?
There's definitely going to be projects, no doubt, and there's definitely going to be things in there that are going to be, are going to have to be reached. I mean, ultimately, if you're going to have a situation, either Biden and the White House are going to have all of the Democrats on board, and that's going to mean making all of his party happy, or it's going to mean giving the Republicans some things they want. And that inevitably is going to involve ensuring that the representatives from these various places around the country are getting the projects and the kind of programs that they want. So you can call it pork, you can call it whatever you want, but yeah, certainly this is not going to be just a simple, we're going to build some roads and bridges across the board. There's going to be lots of different ways this is going to get skinned, and every single representative in these talks is going to want to make sure that their district is getting what they want.
Yep, and that is always the story. Ben, thank you. Ben Bain down in D.C. Tom, isn't that the essence of a good negotiation, that when you come out the other side of it, everyone should have something they're unhappy about, just a little bit. There should be something.
Sounds like the morning surveillance meeting to me.
Our morning meeting that lasts about 60 seconds.
Oh, well, that's the one, John, that you and I go to. What you don't see is the planning. 20, 30 people in the room, about 4:30, really blocking out.
And for good reason, they push us to one side.
They leave us out of the meeting, but there's incredible issues about, like, when do we say the pendulum of inflation?
The pendulum of inflation or the pendulum of doom?
Well, it can be either one, but the pendulum of inflation was a 20-minute discussion with Lisa.
Big upside surprise.
Called in.
Looking forward to seeing what she's got to say about that when she comes back on Monday.
Come on, folks, can we be honest on radio and TV, coast to coast and worldwide? John and I miss Lisa's
gloom. Of course we do.
It's been, it's been way too optimistic.
And we've had a sell-off this week as well.
I know. I
look for an enjoyed that.
I would have gotten into the market if she'd been here.
Would you really? I doubt it. Up 0.6% on the S&P 500. Yields in a basis point on a 10-year 164.54. On radio, on TV. This is Bloomberg.
Traders, I'm going to place an order to sell short euro. So if you're looking to trade euro, here is your chance. The price I'm looking to sell 121.15. Okay, let me place order to sell short at 121.15. Looks like it's moved already. Let's see a couple of candlesticks where it will go. If it will move lower, well, tough luck, and I will have to cancel this order. For time being, if you want to trade euro, you can place order to sell short at 121.15. Okay.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Myself together this morning from New York City. This is Bloomberg. Here's your price action this Friday morning. Equities up 27 on the S&P, up about 0.6%. The Nasdaq advancing nicely, up a little more than 1 full percentage point. The story of the week, lower into Friday, the biggest weekly loss on the S&P 500 since about January. Tom, you often joke about I need to find an entry point, and I always think it's interesting to actually think about that concept, because it's only when you have real 20/20 hindsight that you realize there was one. So Apple's down about 14% so far from the highs of the year. Is that your entry point? Had a nice bounce yesterday. I've got no idea. Is growth on sale? Some people have made that point, Tom, over the last week.
Well, they have. You mean the growth value dynamics there?
Big mega caps.
We had a good conversation there on the mega caps. As everyone knows, I mean, I make a big joke about this, and we love to play along triple leveraged. There's been, John, tons of research on this, that within what's called the log normal space, it's really hard to get back in when you get out. If you decide to get out of the game, how do you get back in? When do you get back in? And on position sizing, the how muchedness of it. How much do you put back in when you get back in? Those are all really serious issues for pros.
So that's why I always find it uncomfortable when people start talking about the easy money has been made.
Exactly.
There's nothing easy about it.
No.
It only looks easy when you look back and the line does that, higher and up towards the right. That's the equity market. Here's your bond market. 2s, 10s, 30s, shaping up as follows on 10s. Yields come in about a basis point to 164.37. Talked a lot about that range. Low end of the range in Friday's session. Last Friday, intraday, 146. Don't know, Tom. Got to see the print 1 hour from now in 60 minutes. The higher the year, 174 into the back end of March on a closing basis. Intraday, the recent high, 170. That was yesterday. So that's your bond market. Here's your FX market. Euro dollar. Bit of dollar weakness out there today. A lot of talk about a better euro potentially in the future. Euro dollar right now, Tom, 121.13. Do you know what the year-end median forecast is on euro dollar?
No, what is it? I don't know.
Where we are right now.
Which function did you get that off of? EC?
FXFC. Go.
FX what?
FXFC.
I don't know that one.
You can check it out right now.
Thank you.
121.13, stronger euro on a session, weaker dollar this morning. With his stock movers, there's a lot to discuss. Here's Romain. Hey, Romain.
Hi, good morning, guys. Two most entertaining guys on morning television here. Let's take a look at the movers. A lot of talk here about Disney. Of course, they did miss on those subscriber numbers with regards to Disney Plus, going down from about 110 million to about 104 million. But when we heard from Bob Chapek yesterday here on Bloomberg Television, as you would expect, he is upbeat, but there's a sort of a reason why he is upbeat. Of course, the Disney park starting to get back up and running. He says there are going to be a little bit cautious with that reopening, with the capacity here, but he really made it clear that there is a pathway here, not only for parks.
As you can see, I have to cancel order to buy, order to sell euro. It moved, let's see, last chance. Now it moved away. Let's see what's happened after this candle. Now I will cancel order to sell short. Let's wait for better time, okay? Order to sell canceled. Please do cancel as well, because it looks like it's moving. You never know where it moves, up, down. Okay, let's wait for another chance.
But again, we're talking about a drop here of what, if my math is correct, about 6 million people. And that's not huge here for Disney. This is a juggernaut. This also isn't a company that is solely dependent on streaming the way Netflix is. It is that proverbial flywheel here. And you'll see how that sort of feeds into its other properties, including parks, including licensing here. That is going to be a big read here, though, on the reopening. As Chapek himself even pointed out, those shares down 4% here in the pre-market. Another part of the reopening trade here is DoorDash. Those shares up 9%, sales tripling in the most recent quarter, but that came at a huge cost. Of course, it reported a loss, and now the question investors want to know, Tom, really is here is what is the sustainable growth rate post-pandemic for DoorDash, and is that sustainable growth rate going to be done, I guess, at a profitable level here? Also, sort of in the macro space here is Plantronics. We don't talk about this company a lot, a headset maker. They're really hurt. Sales were really hurt here by that chip shortage. The company basically made it very clear here, going forward, its sales is almost really completely dependent right now on some right-sizing here in that semiconductor space. Flip up the board. I want to get you to a couple of quick names here. The cryptocurrency space is managing to rebound a little bit here. I know you were worried, Tom, but Square higher here. Coinbase also higher. They reported earnings. Transaction volumes doing well here. The company giving a pretty decent forecast here for those transaction volumes. All of the crypto coins right now also higher here earlier here in the morning, including Bitcoin, Ethereum. That's your outperformer once again. Fisker also higher here. A big deal here with Hanhai. With basically this is Foxconn. They're developing that car, if you remember. They're now saying they're actually going to have a plant here in the U.S., expecting to roll out a prototype. Hopefully, we'll see it sometime this year. Those shares up 17% here pre-market.
Romain Bostic, thank you so much to close this afternoon.
Thanks,
Right now, joining us on Nomura, Louis Alexander. We're thrilled that he could join us here to wrap up an economic week. Lou Alexander, I want to rip up the script, and this I can do with all of your heritage at Stanford and Yale, and that is the ancientness of cost-push inflation, the ancientness of pricing power, and the dynamics of the American corporation. Is the American corporation now, with its monopsonistic tendencies, its power of technology, its power over labor, do we need to worry about pricing power, or is that a thing from the past?
So, look, I think what you're seeing right now is that in those areas where things have been disrupted, there is some pricing power. But I don't think it's actually very broad across the economy. And so, yes, we've seen some evidence that you can push things up. But I think when you look at it more broadly, it isn't obvious. So if you look at things like the measures of consumer prices that look at the whole distribution, what you see is the price increases have been very concentrated in some areas. And look, we've had a big burst in demand in an environment where we've got some significant constraints on supply. It's not surprising that prices have gone up, but I don't think at this point that's signaling a broader problem. Look, if it gets into inflation expectations, we have a problem. But so far, that hasn't happened in a big way.
Going forward from here, I think it's a big question, and Bank of America have the following quote, and I'll read it out, Lou, and I'll try and get you to help me understand it a little bit better. Big and repeated one-time jumps in prices are building a foundation for sustained inflation. I'll read that again. Big and repeated one-time jumps in prices build a foundation for sustained inflation. Lou, can you walk me through that, just conceptually, how these big one-time jumps can actually lay a foundation for more sustained inflation?
To me, that is if it gets into people's expectations. If people start to expect those kinds of increases on a regular basis, that will then give the inflation process some momentum. And so one of the most important numbers we're going to get today is the Michigan survey, the initial survey for the month of May, which has in it one of our major surveys of long-term inflation expectations. If that goes up in a material way today, that will be the biggest red flag we've had about the outlook for inflation going forward. So I do think there is a fundamental question of whether or not this surge in inflation is going to add momentum to inflation going forward through that process. That, to me, is the most important question.
Are you ready to place stop and profit for Japanese yen? Okay. By placing stop and profit, all of you guys who followed our trade, who started this morning, here is your chance to make a profit. If it will change direction, you will sell with 2 pips in profit. Okay. I'm placing a stop and profit at 109.330. Okay. So in our case, it's because of Japanese yen, it gives 20 pips. In reality, every pip, every 10 pips with Japanese yen gives us 100 pounds in profit. So in this case, it will be 200 pounds in profit, but don't sell. Let's wait. If it will move lower, we will move in our advantage, our profit. Okay. Well done, guys. If for new guys, if you want to find out how we trade, you need to get a strategy that's available on companyeye.co.uk. Okay. Don't forget to register for next one webinar on Wednesday, and you can register also for 15 minutes one-on-one session. That's free. You can ask any questions, and I will try to answer it with all of my power, what I can, as long as you won't ask some silly questions, I will try to help you with your day trading. Stay safe, and I'll speak to you later.
A bunch of these things are clearly things that are not going to last. So, for example, the chip shortage that has constrained the supply of cars that help push up used car prices is not something that I suspect we'll be talking about 6 to 12 months from now. And therefore, that's not going to be a thing that's going to be pushing inflation up. The sort of the rise in airfares and lodging prices that were such a big part of the CPI. Again, obviously, with people coming back to those sorts of activities, those prices are going to go up, sharply for a while. But again, 6 to 12 months from now, I doubt that's the thing we're going to be talking about. But if this gets embedded, if what happened this week with the CPI starts to affect the way workers and businesses think about what they should expect going forward, that's the thing that will give this some momentum.
Lou, got to leave it there. It's always good to hear from you to get your perspective. Lewis Alexander there, Nomura, chief US economist. Tom, retail sales in about 50 minutes time, your estimate month on month, the headline number positive 1%. I know you look at the control group, we're looking for negative 0.2% for the month of April.
Who knows? It's a crapshoot. What I see is a boom economy, and Carl Tannenbaum mentioned that as well. I talked about the academics of Lou Alexander, Stanford, and Yale. We got to greet, John, a new member of our team out of the University of Oxford, John. Pretty
Very cool.
Fancy.
Who we send hello to?
Some guy, I don't know his name. It's some foreign name. Merton College, and his degree was in philosophy and teleprompting.
Some guy.
That's pretty cool.
Some guy. Oh, it's Kieran Prompting.
Yeah, it's great. It's
Kieran,
4 years.
Kieran Prompting the show.
4 years at Oxford. He goes to Merton, and he's got a degree in philosophy and teleprompting.
Can Kieran scroll to the next bit? Who's in the tease, Kieran? Oh, here we go.
Oh, that was great. Kieran, that's great.
Thanks, Kieran. That was great. It's disappeared. Can you come back down again on that? We're going to talk about the Walt Disney Company next. Thank you. Kieran, we appreciate that. Thanks for jumping in the seat.
No, we don't, actually.
People think we're joking, Tom. People think we're joking. From New York City, this is Bloomberg.
It's Friday.
With the first word news, I'm Rishka Gupta. Israeli warplanes have now been joined by ground forces in their attack on Hamas targets in the Gaza Strip. Tanks and artillery are firing into Gaza from the Israeli side of the border. Meanwhile, Hamas militants continued launching rockets into Israel. So far, more than 100 people have been killed in Gaza and 7 in Israel. The CDC is signaling a broad return to everyday life in the U.S. The agency says fully vaccinated Americans can get rid of their masks in most settings, even indoors or in large groups. The Biden administration is making clear that the guidance is a further incentive for people to get the vaccination. And Bloomberg has learned that the group of rich government creditors known as the Paris Club is willing to delay a $2.4 billion debt payment from Argentina this month. That's if the country meets certain conditions, potentially averting a damaging default. The Paris Club is hoping Argentina can rework a $45 billion agreement with the International Monetary Fund. And former Treasury Secretary Larry Summers says he's now even more concerned about inflation than he was. Summers spoke to Bloomberg's David Weston for Wall Street Week.
It's faster, much sooner than I had predicted, and I think that has to make us nervous going forward.
And you can watch all of that interview with Larry Summers on Wall Street Week today. That's at 6 p.m. New York time on Bloomberg TV. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
CDC's guidance in terms of the relaxation of the mask requirement, we think it's again going to be a big catalyst for growth and actually being able to put the number of people in our parks that we're more accustomed to. So it's very, very positive. Our future bookings are looking really great. In Walt Disney World, in fact, they're already back up to fiscal year 19 levels.
Bob Chapek there, the Walt Disney Company CEO. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz will be back with us on Monday. Here's your equity market. Equity futures up 28 on the S&P 500. We advanced 0.7%. Into the bond market, yields lower 2 basis points to 163.86. Foreign exchange, euro stronger, dollar weaker, euro dollar 121.21. And in the commodity market, WTI 64.64. That's easy, up by 1.28%. We advance on WTI. We switch up the board and get to the Walt Disney Company. We trade lower in early trading. In the pre-market, we're down a little more than 4 full percentage points. This off the back of the streaming business. Subscriptions, Tom, coming in just a little bit lighter than expected.
Let's go to this right now. We are thrilled to bring you Craig Moffett, Michael Nathanson. Moffett-Nathanson, of course, for decades at Sanford Bernstein. They are definitive on what we do in our houses and what we watch and when we watch it. Michael Nathanson, let me go to you first on Disney. I know John's got a bunch of questions, too. To me, it was just simply they didn't have Mandalorian 2. How much did Disney and Mr. Chapek miss Baby Grogu?
They missed by about 5 to 6 million subs, and in the new Disney, that really matters. So it's perverse, but they crushed every other number, but Disney Plus subs. And unfortunately, that's what happens when the stock trades the way it does.
I mean, it's the way it is, and it's a battle out there. Craig Moffett, you've been doing this years, particularly the cabling of it, the routing of it, and what we do with our checks. What's the theme for you, Craig Moffett, right now into the summer in the streaming wars?
Well, as much as the streaming wars dominate the video side of it, the companies that I cover, especially AT&T and Verizon, you can talk about media for them if you want, but fundamentally it's about the wireless business. And while streaming is sort of a benefit that they give away for free, the real battle is going to be on networks, capital investment, and 5G.
You mentioned capital investment. I don't need we don't have time now for a treatment on Verizon, but are the traditional companies, Craig Moffett, that you follow, done pretending that they can be the companies that Michael Nathanson follows?
Not entirely. AT&T is making a good go of it for HBO Max, for example. The problem is all of HBO combined is less than 4% of AT&T. So while it's a good story, fundamentally it's got to be about other businesses for them.
Michael, I'm just trying to work out why the Walt Disney Company's done nothing all year. The stock has done absolutely nothing after a huge move into year end.
Well, John, we had those two huge moves, and it went to a level that you had to do all this fancy math, some of the parts, price to sales multiples, to justify where it was. And everyone had a chance to buy it after the investor day. They did. And there was not, there were not buyers at that level. And you're right. It's, we were neutral on the stock. We thought it had overshot valuation. And now we think it's going to grind lower, and there'll be some point we become constructive on it. But we've had a hard time looking at things, some of the parts, right? We are earnings and cash flow analysts. And we thought, look, let's just wait for a better entry point, which I think is going to happen.
Well, let's talk about what drives that better entry point, Michael. What do you think it is? What's the catalyst for a move lower from here?
Well, I think it's some of the air coming out of the valuation on Disney Plus, right? The people were using 10 times revenues on 2025 to get to a Disney Plus number, right? So I think Disney Plus has been a great story, but 1/3 of the subscriber base has come from India with an ARPU of less than $1, right? So you need to be cautious on how quickly you want to give it Netflix status on valuation, and that's been our point. So I think it's just more focus on what's the valuation of Disney Plus. It's been a great story, but it's probably not worth $200 billion today.
The problem with you guys is we spend all our time, our love with Michael Nathanson is because it's romantic to talk about Disney and all that. Craig, you get no love. I'm going to Craig Moffett right now, folks, on the boredom of my cell phone bill, T-Mobile, and all that. The biggest unsaid success, Craig Moffett, in decades has been Leger and T-Mobile. Does T-Mobile continue to crush American cell phone competitors?
Yes, flat answer, yes. We think about it. This is a company that has been priced 16% below AT&T and Verizon in their consumer prices for cell phone service for years, in large part because their network wasn't as good. Now we're going into the 5G cycle where not only are they cheaper, but they're going to have the best network of any of the three of them. And those kind of worst to first stories are very rare in American business. And when you find them, they're really exciting.
Do they sustain that? Can they stay first? I mean, you look at T-Mobile as the premium and sustainable cash flow.
Yeah, because telecom cycles are not 1 and 2 years long. You don't build a network in a couple of years and then somebody passes you a year or so later. These are 10 and 20-year cycles. And so we're going into the 5G cycle that's going to last well more than a decade. Where T-Mobile takes a sustainable early advantage and likely holds it for a decade. So, they're 10 years into this cycle already, and they've got another 10 years in front of them.
Michael Nathanson, I got to bring it back to you. I guess everybody's still chasing Netflix. They had the huge success, Mank, the Oscars, and they had Queen's Gambit and the rest of it. What's their pipeline look like? And are they still wedded to the pipeline to keep Paramount Plus and Disney and the rest of them away?
Yeah, it's interesting. They've hit a dry patch, as everyone has, just because of the pandemic. But they're going to come back with a ton of content in the second half of this year. And they put a lot of emphasis on big movies. So you're going to see some major blockbusters coming from them that you would have thought were theatrical releases. They'll be on Netflix. So there's a bit of a temporary pause. We think towards you get to the fall, you start seeing that, what you described as those previous hits coming back. But you have a period now where HBO Max is probably going to take a lot more shares because they have theatrical release movies that are going on HBO Max day and date. So we have a bit of a slow period before I think it heats up again, in the fourth quarter.
Michael, I wonder whether we're reaching that point where people look around at the cost of all these streaming businesses and just say, I'm not doing this anymore. £15 here, £20 there, £10 here, $10, $15, wherever you might live. Michael, and they just say, no more, I'm done. Because we've been talking about competition, and I noticed the Netflix miss, big miss. The Walt Disney subscribers miss, big miss. Is something brewing here?
Yes, John, and we think this is what's brewing here is you had a year of a major pull forward, right? When we've been doing this, we're doing this from Zoom. Past 12 months, if you're stuck at home, you're streaming, you're not doing anything else but streaming. Thank God we're getting out of our house. When the world opens up, I think people will look at their bills and reassess. So we have a thesis that, we think streaming wars will pick up, but also streaming consumer adoption will slow the next couple of quarters. So, we've not recommended Netflix and Disney. Those are great trades last year. So we're more cyclical. Advertising-based names as the economy strengthens, and that's been the call. We think it's the right call. But your point is right. As consumers change their spending behavior, some of those streaming services will see either higher churn or less adoption.
So you're taking me to Facebook, essentially.
Yep.
Those kind of names.
Facebook, Google, those are the names. Snap. Although you say, hey, doesn't everyone recommend them? They're still really attractive stocks given the growth outlook.
Both of you jump in here. Unfortunately, I think this goes to Michael Craig. I'm sorry for that. But the Super League, English football uproar, what's it mean for the gajillions of dollars that's negotiated for this strange game called soccer?
Well, Tom, that's a Craig question. That's a Craig question. So
yeah, I was going to say, the Premier League just renewed with a flat contract. In fact, they didn't even open it up to bidding in the UK. So they've renewed with Sky, so it stays on. And I think probably that, as it turns out, works out well, because I don't know that they needed the extra publicity. There's a lot of animus over the whole Super League debacle, and a lot of unhappy fans that still have a bad taste in their mouth.
Craig, I couldn't agree with you more. Go on, Michael.
Yeah. Ironically, although football prices in Europe are flattening, in America the prices keep going up, right? Our market's really tied to multi-sport in a way that Europe isn't. So we keep seeing steady increases in sports costs here.
Craig, we never get to talk much. I'm sorry for that.
Let's talk, John.
Just me and Michael all the time. He's always taking your airtime. Craig, we've got to leave it there. Craig Moffat and Michael Nathanson of Moffat Nathanson, founding partners at Senior Research as well, analyst. Tom, that's the situation at the moment, and I think Michael's point on the streaming business is a really, really interesting one going forward from here. There was a ton of pull forward last year.
Yes.
And it's not a coincidence that we saw a big miss at Netflix and a miss over the Walt Disney streaming side of things as well.
Totally agree, and I guess the pipeline's coming on, but to me, they're just completely at the next new idea, the next new show, the next new product. John, what do you think about English football, Premier League in American
But actually,
TV?
it's a question for Craig. It's actually a question for the broadcasters, for the companies that have the satellite businesses. I don't think it was a surprise that the people who worked for Sky Sports were very, very angry about what was happening with English football or what was proposed to happen to some of the biggest clubs in England. There's a lot riding on the football rights that they pay for. That's just my particular view on what played out in the last couple of weeks.
I mean, it's really, I mean, I'm just not focused, John, because, I'm reading like Harry Kane. This is it. Could this be Harry Kane's last
You think he's going to leave?
Tottenham?
No idea. No idea. He's a great player, Tom, and he needs to be paying for a club that plays at the top of European football. And right now,
like, leave England.
Your team is not one of those clubs. It's not unusual. We've seen it before in the last 20 years for a member of a London team to go to another London team. And Harry Kane did used to play for Arsenal as a kid. So, who knows? I'm not saying he's going to Arsenal. I'm not going to do that to you, Tom.
Could he go to, like, the Italian league like Ronaldo did for
He could go for one of those big teams. He's good enough.
Really?
Yeah, he's good enough.
Like
I just don't know if he wants to.
He could go to AC Milan.
I wish we could have a striker as good as Harry Kane over at AC Milan. From New York City this morning, good morning.
Soccer talk
Alongside Tom Keane, I'm Jonathan Ferro. We really didn't do much this week.
No, we didn't. It's because Lisa wasn't here. It's just,
This is Bloomberg.
The pendulum of soccer talk.
more traffic.
Okay.
During the pandemic, no traffic.
Okay. Where do you see the oil market in about 20 years or so?
Non-existent.
Have you ever thought of bottling your happiness? And you know, you could make a lot of money if you bottled your happiness.
Yeah, you know what it is? It's just gratefulness. I should have died in that field in Iraq.
Valuations, particularly, you know, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There are structural changes going on in an economy. It becomes very difficult for economists to forecast with any degree of accuracy.
No, we're not done with the adjustment to a shock. Big shock down, big shock up.
The equity market is telling you that there are inflation fears all over the place for investors.
The risk of that is rising, but we should be a little careful about...
Okay, guys. As you can see, position closed on Japanese yen. 109.330. We closed position, we got 200 pounds. In your case, it's all about how much you decided to invest. If you're struggling, if you don't know well how much to invest on certain pairs or indices of stocks, you need to get a strategy. It's all explained over there. The only things I can advise you, never invest 100% of your trading account. How much? We'll explain everything in the strategy. So if you will go to company.co.uk, get the strategy, and you'll find out all information about investment, trading, day trading, what you can trade, everything. If you will have later on afterwards any questions, you will have live support from us. We'll support you for life, so you don't have to worry that you will lose anything, because we never lost for years any money on investment. Okay, I'll speak to you later. Well done, guys, who decided to trade Japanese yen. And let's move on. Let's go to and look for another trading chance and opportunity to trade Forex or Bitcoin. Stay safe.
Yield, and we've inched towards zero over the last couple of weeks. Where are we now? Negative 10, 11, 12 basis points, something like that. We have been much, much lower than that. And that's why for many people, the ECB meeting on June 16th gets a whole lot more interesting. If yields carry on climbing, and not so much Germany, but on the periphery in Italy, we've had a really nice move through 1%. I say really nice. It's not nice for the Italian Treasury, and it might not be nice for the ECB either.
Let's stop the show here, John. And, you know, folks, I got to admit, the first time I ever saw Pharaoh on TV, he was in some cafe in Frankfurt, like doing a remote on ECB. John, seriously, do they want a negative yield or a positive yield in Europe?
I think they care about the direction of travel. I think they care about that. I think they want stability more than anything. They don't want to see a bond market with yields going through 1% and then we keep moving. They want to introduce some stability into the bond market.
What about the bankers, Mr. Saving at Deutsche Bank?
Well, they clearly want higher interest rates.
They want a positive yield, right?
Tom, we'll go back. Let's go back 7 years when President Draghi first took rates into negative territory. That summer of 2014. In fact, you and I were together here in New York when that happened. And I remember when it went into negative territory on the depot rate, and in the subsequent years and months, President Draghi would talk about rates needing to be lower now to be higher in the future. And I've repeated that line many times because they have gone lower. They've gone even lower. They never came higher again. And that's been an issue.
And just now we begin to see that. Maybe that's a song here for June as well. John, let's do the data right now. Green on the screen. 3 days of carnage. We had a correction. It was terrible.
Is that what you're calling it?
John and I disagree on this. I'm like, would everybody calm down? And John's seeing a little bit of damage. Futures up 29, Dow futures 178. The VIX from a 27 level, John, comes into 21.38, and bonds on board.
164, yields come in, a couple of basis points. Your high of the week,
yesterday.
170 from yesterday. We had to move intraday yesterday through 170. We're at 146 this time last Friday after payrolls. You know, I'm not trying to add some drama to this, Tom, but we've had some moves over the last week in this Treasury market. I'm with you that we haven't gone through the highs of March. 174 on a closing basis, a little bit north of that on an intraday basis, but sure. But we've had some vicious moves up and down over the last week.
You're overselling it. Come on, there's no drama, John. I mean, Lisa would say the pendulum of drama, it's not there.
I'm not trying to make it sound more dramatic than it is. I think we've had some big data, a lot of misses to the upside on inflation, to the downside on payrolls.
Right.
And we've had some volatile data, and it's been volatile for treasuries this week.
We're going to start strong here with equities, but I do want to mention one thing, folks. I noticed this. It's a better statistic right now, but I looked at Turkish lira out to new weakness, and I really wonder if that was off of the challenges of Israel and the Palestinians. We're right now, lira 8.43, but I had a 850 statistic there, John, 12 hours ago.
TK, can I just fit in a foreign headline as well on the foreign policy front, on the international front?
Sure.
The Hong Kong entrepreneur who you will remember has been sentenced recently for pro-democracy protests, just getting a report that Hong Kong is to freeze Jimmy Lai's assets, citing that recently introduced security law. I say recently, of the last couple of years, Tom.
Then what does it mean for Hong Kong, American domiciled, British domiciled banks? I don't get the delinkage of that. Everybody telling us they're not linked to headlines like that, and I suggest baloney.
I don't think the companies, the corporate officers, the people working in the C-suite want to talk about it too much, Tom.
They do not.
I think for the expats, though, they'll be voting with their feet at some point. And I think we're already starting to see the data behind some of that in terms of the intentions, too.
We'll have coverage on that. And, of course, look for our team out of Hong Kong with further coverage into their weekend and, of course, on their Monday. Look for that Sunday evening in New York. Right now, Patrick Armstrong joins Plurimi, Wealth Chief Investment Officer. Patrick, just simply here, how brave are you on a Friday in May?
I'm relatively brave. I still like equities. I think going into the year end, equities are going to be higher than where they are. I think you want to be positioned in equities that are trading below market multiples. And some of the equities that are benefiting from the shortages that are creating the spikes that we're seeing right now. So commodity producers I'd prefer than commodity buyers, chip manufacturers rather than people or companies who are buying those chips. So you can get a lot of stocks, low-teen multiples with growth.
Patrick, there's 12 stocks trading under market multiples. I'm kidding. But where do you find them?
Well, all those ones I've mentioned, like my portfolio right now is trading at 14 times earnings, which is...
come on, define it. That's phenomenal. How do you do that?
Well, Moderna's trading at 8 times earnings. Everyone's pricing that they're going to get everyone vaccinated, and then Moderna's going to have no revenue anymore. So Biden's talking about getting rid of their IP. EU's pushing back against that. I don't think it makes any sense to get rid of a company's IP for when the next pandemic comes here. We need the pharmaceuticals, the vaccine makers incentivized to get us these vaccines quickly like they did this time. So you can find companies, Moderna, BioNTech, they're both trading single digits. Fortescue, the iron ore maker in Australia. China's pushing back on iron ore a little bit today, but again, 7 times earnings. These are things that are cyclical. But if you expect the economy to keep moving forward, you shouldn't mind cyclicality. And if you can get them at single-digit PEs, for me, I'm very happy with that.
You've given us a little flavour of the portfolio then, Patrick. So to repeat what you said, you like the commodity producers, the miners, not the commodity buyers, the chip makers, not the chip buyers, who would be the autos, I imagine, and more broadly, the smartphone makers as well. Maybe we can talk about that in a moment. The chip makers, the stocks index is down about 12.5% from the highs of early April. Patrick, what do you make of that? Where do you find the chip maker that you want to be active in, present in?
I like a diversified exposure. So I like ASML that creates the equipment for the chip makers to make their chips. Tokyo Electron, the same kind of thing. Skyworks on the handsets, a big supplier to Apple. I just think you have companies clamoring for chips they can't get a hold of. They're going to pay up for them. You're going to have strong revenue growth. You're going to have strong margins. It'll be expanding. And the shortages, it's going to turn into hoarding. It's just human nature. When buyers from phone, Apple, they can't get a hold of the chips, they're not just going to buy what they need. They're going to hoard them, and that's going to lead to another wave of buying. So I think this is extended for a little bit longer than we expect because no buyers want to be in a position where they can't manufacture their goods because they can't get chips, and that's going to lead to more demand than you'd even expect. You see it similarly in gasoline demand in the United States right now and what people are doing.
Is it opening up some opportunities, though, further downstream in the supply chain, Patrick, from the chip makers down to the smartphone makers, down to the auto producers? Are there some opportunities there right now?
Well, I think the chip makers is where you want to be playing it. I think tech sold off because of higher inflation leading to higher interest rates, and tech is high multiples. But the chip makers, I don't think, fall into that. So I think the baby was thrown out with the bathwater a little bit there. And within tech, you want to be looking for some of the lower multiple stocks that have pricing power. And I think the whole suite there of chips makes sense to me at this point.
Patrick, smart, always strong. And we didn't talk about Europe, Tom. We need to do that next time. Patrick Armstrong there, Florimi Wealth Chief Investment Officer. Just to sum that up, Tom, buy the chip buyers, or rather buy the chip makers, not the chip buyers, and buy the commodity producers, not the commodity buyers.
You got to have the courage to buy the value, and it takes courage because the other stuff is so popular. It's a really interesting conundrum. Tempting is the right word. It's a really large conundrum. John, futures up 28, Dow futures 170. I mean, the Dow's back above 34,000. What crisis?
Is that what we're following? The NASDAQ 100's up 136 and up a little more than 1%.
The Standard & Poor's is nicely above 4,000. I mean,
I'm not complaining.
Back and forth.
Up 0.7%, up 28 points. We're doing okay.
Are we range bound, though, John? That's really, seriously, that's a philosophical discussion. Into the summer, everybody's up, or gloom, down, Lisa's down.
Yeah.
And the bottom line is, what about range?
Look, I think it's really hard to make the argument that the cyclical upswing in this market is particularly damaged when we don't see enough of that damage spill over into, say, credit. I think that's a pretty tough argument to make if you're not seeing it reflected elsewhere. And to your point on some of the big moves, since some decent moves in equities, since some volatile moves in the bond market, we're basically back to where we started, though, in and around 160 on 10s.
I did that. When I emailed you on big moves, I was talking about, should I go to lunch in Soho? I mean,
You're going to come downtown?
I think I should come downtown today, And,
I'll meet you downtown, but I don't finish until 1:30.
Well, the real yield on. Let's shape up the real. Seriously, shape up the real yield today. What's the major theme there? You should try to set up fixed income to get to Monday.
The volatility in the data, and a question I've been exploring with various bond managers, is whether this bond market's become less sensitive to the incoming data because the incoming data is becoming so volatile.
What is this graphic on radio, folks? John's got some museum of modern art graphic on Bloomberg Real Yield.
Promotion.
Thank God they're listening on radio and not looking at
1 p.m. New York, 6 p.m. London, 1 a.m. in Hong Kong on a Saturday.
Yeah, Steve Engels up. Steve Engels up. He's at the Mandarin Bar watching the Bloomberg Real Yield.
I hope he is. From New York City this morning, good morning. Heard on radio, seen on TV. This is Bloomberg Surveillance.
On TV, Soho.
With the first word news, I'm Ritika Gupta. The fighting between Israel and the Palestinians has taken a new turn. Israeli ground forces are now firing artillery at targets in the Gaza Strip. Israeli warplanes continue their own bombardment. Meanwhile, Hamas militants are still firing rockets into Israel. More than 100 Palestinians and 7 Israelis have been killed. Republican senators say they're encouraged about the chances for a deal on infrastructure after meeting with President Biden. One of the 6 Republicans who went to the White House, Shelley Moore Capito of West Virginia, called the discussion very productive. She said the president told them to come with their own proposal so he can react to it. And Hong Kong is freezing the assets of jailed pro-democracy media mogul Jimmy Lai. According to local media reports, those assets are worth more than almost $64 million. It's the first time authorities have used the power of seizure granted by a new security law. Lai and 2 of his former associates are scheduled to go on trial for fraud next year. And Singapore is returning to the lockdown-like conditions it last imposed a year ago. Officials blame a rising number of untraceable coronavirus infections pressures. Singapore had been one of the most successful places in the world at COVID containment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
is on the worried side about inflation, and it's all moved much faster, much sooner than I had predicted, and I think that has to make us nervous going forward.
That certainly makes the former Treasury Secretary Larry Summers nervous. You can watch the entire interview tonight at 6 p.m. on Wall Street Week with David Weston. Looking forward to that later. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramit's back with us on Monday. Going to run you through some price action about 1 hour and 12 minutes away from the opening bell. And about 12 minutes away from a retail sales print in America, which Michael McKee dropped by, swing by, and bring you some information on. Your equity market, positive, up 27 on the S&P. We advanced 6/7% on the NASDAQ. The NASDAQ 100 advancing 1.07%. Do you want to quote the Dow, Tom? Do you want to get that in?
No, I don't need to do it right now.
All right, through 34K. That was just for you.
Happy.
You can pay me later for that. In the bond market, yields coming in 2 basis points.
A beverage.
163.69.
Group and really riding herd on the state of American retail is Joseph Feldman, and he joins us right now. Joe Feldman, I want to talk about the American spirit of retail. I see it in luxury. I want you to pull it to Home Depot next week. You go down Madison Avenue, and there's Hermes of France ready to put $1 gajillion into a double storefront, and right across the street quietly, Manolo Blahnik, which I believe makes women's shoes, is building another fortress. I mean, people are building into this recovery, aren't they?
It seems that way, and the consumer is certainly building too, which, you know, to segue to that Home Depot thought heading into next week, we're going to should get good numbers out of Home Depot and Lowe's. I think the consumer is definitely armed with cash. You know, there's been stimulus payments, tax refunds have been coming out. You know, everybody's feeling a little better about the COVID situation right now, and it seems like there's been this pent-up demand for a while that's been starting to unleash itself, and we're seeing spending at retail.
Right. How do you and Dana, as you drill into the micro of this, respond to headlines from McDonald's or headlines from Amazon that they've got to raise wages? Is retail, across all of retail, going to have to lift up the wage, and what does that do to margins?
Yeah, we are seeing wage pressure across all of retail. That's something, wage pressure and freight pressure are two things that all the retailers have been calling out. But now that's baked into the numbers. I think it's baked into the stock prices. I think most of us have been expecting this now for this year. And really every year you're going to see wage increases going forward.
Joe, is this due to a worker shortage, though? I guess what I'm trying to ask is, for some of these companies, are they doing it because they believe it's the right thing, or doing it because they have no choice?
I think it's a little of both, to be perfectly honest. I think that you're seeing, you know, it's more competitive out there. We're hearing more pressure on the restaurant side than the retail side in terms of getting labor back into the labor force, as people are still, you know, maybe benefiting from some of the stimulus that they've been provided. But it does seem like there's still a very tight job market, and, you know, people are out there, and if they want a job, they can seem to be finding one. I do think that we're going to see that pick up and normalize through the rest of the year, where we will see the retailers start to, you know, be in better shape from a labor perspective. But a lot of them have learned how to operate more efficiently over the past year and a half. So, you know, we may not go back to full strength at all the different retailers out there.
Joe, when you think about that labor market tightness, are there various places across the country where that tightness is more acute?
Yeah, that is absolutely the truth. And, you know, it depends on the markets. You know, as somebody, you know, one of the retailers I was speaking to the other day had put it, you know, it's a very big difference, the stimulus checks that you might be getting in say, Montana or Wyoming versus Queens, New York. And the impetus to get back into the labor force might be different for people in different parts of the country. So we'll have to see how that plays out. I would think that, you know, by the end of the summer, it feels like we're going to start getting back into a more normalized situation, though, where the retailers and the restaurants and the lodging group are able to fulfill, you know, their needs in terms of a labor force.
I mean, Joe, I look at retail now. In going through this pandemic, where we're buying from Walmart, we're buying from Amazon, and we're buying things we never thought we'd buy. I mean, John Farrow is buying bushels of Walker's Pure butter shortbread cookies from Walmart.
I haven't had them for a long, long time.
Come on. I mean, there's a British staple. Farrell has 3 or 4 every day before the show. Mohammed Al-Arian's having Walker's pure butter shortbreads at Cambridge. And I can buy them from Walmart. Is that your new world? Is we can just buy everything from these big box retailers?
It seems to be the case. I mean, the world has certainly shrunk over the past, couple of decades. And, we are able to buy and get access to lots of really great quality products. And I think one of the strengths of the big box, the Walmarts, the Targets, Amazons, Costco's, they've been able to bring in those types of products and provide that to the consumer.
I mean, John, you did it with 2-day delivery, arrived Saturday, May 15th.
I have to tell you, TK, on a serious point, I'm with Matt Miller. Matt Miller said something recently that if you don't do 1-day delivery, I'm not participating anymore.
Yeah, no,
I feel that way in a big way, particularly over the last 12 months. Joe, when this first started last year, I remember struggling to get a delivery slot with Amazon. I think that was true for so many people living here in New York City. But once they started coming through, I've not turned back. I don't think I've done a full food shop in a grocery store for a full week of eating for about 9-10 months, Joe. I think it's been that long. I'm just wondering how sticky some of this behavior actually is.
Well, I do think a lot of this will hold. I understand, as the recovery happens, people want to get back out and they're going to start going to ball games again and going to restaurants and dining out. But there will be some element of people that are still going to keep a lot of these behaviors, as you said, shopping for groceries online, having it delivered, and eating more at home is still going to stick. The pendulum will still be tilted towards eating at home more so than it was pre-pandemic, which bodes well for Walmart and Target and the grocers and anybody that's really good at doing it online and being able to deliver it to you more efficiently.
Joe, thank you. Joe Feldman of Telsey Advisory, thank you very much. Very sticky behavior change, Tom. All my grocery shopping now, very much online, almost exclusively.
Oh, I'm the same with my vermouth order. Phone order last night.
I know where that
wines.
gets. Yes, Candy Wines.
Good morning. Well, we're moving up from Manolo Blahnik.
92nd and Madison, is that right?
That's about right.
92nd. I remember. I used to frequent KD Wines. What's delivery like? They tighten that up.
They did tighten it up to 1 hour.
Are they giving you anything for this particular plug for KD Wines?
No, they do not give me anything for this plug.
Did you get a bottle of wine from KD Wines?
I was thinking Dutch champagne.
Dutch champagne.
The Dutch champagne.
Okay.
That's what it is. John, we got retail sales coming up. I'm sorry. I know everybody's worn out from the data. I'm sorry, it's a big deal.
I agree. It's 5 minutes away in the United States of America. And then reaction from the Federal Reserve. Loretta Mester, the Federal Reserve Bank of Cleveland president, sitting down with Michael McKee for a conversation just moments after we get retail sales in America. Going into it, here's the price action, up 28 on the S&P. We advanced 0.7%.
Dow
in the
up
bottom
168
market.
points.
A bid. Yields come in 2 basis points at 163.69. In the FX market, euro stronger. The dollar is weaker going into this one, 121.23, and WTI 64.43. From New York, retail sales next on radio, on TV. This is Bloomberg.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
I certainly feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Looking for some retail sales data in the United States of America from New York City this morning. Good morning. Alongside Tom Keane, I'm Jonathan Ferro. Going into the print, equity futures up 27 on the S&P. We advanced 0.7%. With your data, here's Mike McKeague.
Good morning, John. Retail sales, of course, the number of the day, and we're waiting for that to drop. I'll give you the import price numbers while we wait for retail sales to come up. Import prices on a month-over-month basis up 1.2%. The forecast was for a 0.7 increase, and that pushes them up 10.6% on the year. 10.2 was the forecast, so we are getting some inflation pressure brought in from overseas, and we, of course, do import a lot of stuff. Now, the numbers have not come in from the Commerce Department, and we had this happen last month, I believe, where we're a little slow. Here we go. April retail sales were flat. No change in April retail sales. March was revised to a 10.7% gain. So at this point, we don't see any real benefit continuing from the stimulus. Now, the thing to remember is this is a month-over-month percentage change, so we could still have elevated sales on a dollar basis, but not major change in how much we have. Let me quickly take a look here and see motor vehicles were up 2.9%. Furniture was down, which is a bit of a surprise given the home sales that we've had. Electronics and parts, 1.2%. Building materials down 0.4. Now, one we've been looking at is the food and drinking establishments as states reopen. They're up a fairly healthy 3% on the month. So we did get some business out of them. And non-store retailers, this is interesting. The internet shopping that we've all been doing, maybe we're not doing that so much anymore, down 0.6%. So we had a big increase in sales during the month of March as those stimulus checks came in, and now we're looking at basically not a lot of change since then. We're still spending, so we're flat on the month of April.
Mike, just quickly, just to pick up on a price action, we pulled back just a little bit on the S&P 500. We're still firmer on the day, but we do come in. We're now up by about 0.5%. Bid picks up into the bond market. Yields come in about 2 basis points now, a little more than that on a 10-year at 163. On 30s in 2 basis points to about 236. Mike, it's another downside surprise. First it was payrolls, and now it's retail sales, and the control group is not a pretty read either, Mike. And I understand it's month on month, but this is another miss for the economists out there looking at this incoming data.
Yeah, the retail control group is down 1.5%. This is the part that basically goes into GDP. You take out housing and gasoline. And so that doesn't give you a lot of confidence about the speed, the ongoing acceleration of the economy.
And Mike doing a great job up in Boston there. I would point out the revised month over month came out instead of 9.8% plus a month ago, it was 10.7%. So I'm sorry, I got to revise away the retail gloom here as we get better data moving on. Michael McKee, what a joy. I loved what you did with Neil Kashkari here in the last number of days. And now you got the wonderful mathematician from Cleveland, Loretta Mester.
Yes, Tom, we do. We'd like to welcome the Cleveland Fed Bank President, Loretta Mester, to Bloomberg Television and Radio Worldwide. Thank you for joining us on this beautiful morning, at least here in Boston. Looks like the narrative, President Mester, that the American people are going to be recovering more quickly than everybody anticipated might not be correct. I mean, they're still spending money, but not at an increasing pace.
Yeah, I mean, I think this is probably what we should expect, right? We have pent-up demand coming back as vaccinations have been distributed more widely, and that's a strong demand. We also have supply issues affecting the economy, and this interplay between demand and supply is what we're seeing in some of the data coming out, whether it be today's retail sales report or the labor market report. So the volatility month to month, I think, is something we should expect. I think that what's happening, though, is that we do see the recovery continuing. It's just that we're going to have these month-to-month changes depending on which factors are more dominant. Is it the supply side or is it demand side? And I think the bottom line is it just, we're really at the beginning of this vaccinations widely distributed part of the recovery. And I think we just have to, wait and be a little bit patient and let the recovery continue.
Well, we just got the CDC advice that people don't have to wear masks anymore. I can tell you people in Boston are still wearing masks as they are in New York. Do you think that reluctance to go out and spend is going to fade rapidly now?
Well, it's hard to see how rapidly. I mean, myself, I'm still, wearing masks when I go outside. I think it all is a good sign, though, that we are getting to the other side of this. And I think that the vaccinations still have some further way to go. I think we need to distribute them more evenly across the country. But as that continues, as we can relax mask wearing for those who have been vaccinated, all of that is on a good path to get us back to some semblance of normal. And I do think people are going to feel more comfortable re-engaging. I am feeling more comfortable re-engaging, and I think I'm representative of others that, we have a reluctance, but now as things continue on and, we've intellectualized the fact that we have gotten vaccinated and we are protected, we're going to be more able and willing to go out and re-engage. And I think we're going to see that, over the rest of the year.
This is where I put in my plug to come visit you in Cleveland and do the next interview there. Neither you or I have had a real chance to dig into these retail sales numbers, but the interesting thing about retail sales is they're reported in dollar terms, and so one would have thought that there would be a big impact from the April CPI numbers. What was your reaction to that and the idea that maybe inflation is accelerating more quickly than the Fed anticipated?
Well, again, I think we're seeing the clash between, pent-up demand, the surge in demand, and some of the supply issues that we're seeing. And coupled on, with that also is the fact that the month, year-over-year numbers are really incorporating those very low inflation readings we had last year. As those, come out of the numbers, we're going to just see mathematically inflation going up. But no doubt, we're seeing some real supply constraints in particular areas. I think you were mentioning lumber earlier. There's commodity prices. There's energy prices now with the pipeline issue. So we're seeing those in the inflation data. I think the real question for monetary policy is that going to, abate over the rest of the year as supply comes back on, as some of the stimulus checks that people have are used up. And so I think we're going to see that play out. And my baseline scenario for inflation is that we're going to have higher inflation this year, above 2%. But then as some of those constraints on supply ease, I think we're going to see inflation go back down, and we'll have to, monitor that as we go forward. I'm really focused on inflation expectations because I think that is really where, you'll begin to see if those go up. and they're going up a little bit now. We'll have to look to see whether longer run expectations are going up. And that's really a key to me in terms of, where inflation is likely to go over the longer run.
Wall Street's favorite drinking game is the word transitory with Fed officials. How do you define transitory? How long is it? When would you know whether you're right or wrong about your inflation forecast?
Right. So again, I think transitory is a word that was meant to convey whether those are supply issues that will abate over time, and that's what's pushing up prices, or whether it really is in these underlying inflation measures. So far, we don't see, right, much impact on measures like the Cleveland Fed's median CPI and other measures that really try to look at what the trend in inflation is. And the key to that is this real inflation expectation. So it really is going to depend on how long it takes for supply conditions to ease and get back to normal. And that could take some time. It's going to depend on what commodity we're looking at. It's going to depend on what part of the economy we're looking at. We all have talked about the chip, shortage. That's going to take some time. When we talk to our contacts in the auto industries, many of them are saying it's going to be 6 months to even 9 months for that to get back to normal. So some of those transitory gives the impression of over and done very quickly. I don't think that's what we'll see. I think some of those are going to last longer, but whether that gets embedded in underlying inflation rates, which is what the Fed looks at, that's a different story. And that, in that sense, I think a lot of the supply conditions that are pushing up inflation now will abate over time.
Well, there's definitely going to be a staring contest between the Federal Reserve and the people on trading desks on Wall Street over the next couple of months as we get this economic data. Are you going to be able to resist pressure from the markets if they see concern about inflation and start raising rates? I'm sure you'll tell me, yes, you can. But traders also remember December of 2018.
We have been very clear, I hope, in telling everyone sort of our strategy and the fact that we want to see, right, it in the data. We want to not just base our policy actions on what we project is going to be happening, but also seeing it really in the data. And I think that's a really good strategy for times like this, where you have demand and supply factors clashing and coming together, and the outcomes in the data. So again, I think we're going to be looking at outcomes. Our forward guidance tells us, tells the markets and the public what we're looking at. We want to see inflation go up, and we want to see it be on track to go above 2%. And that's, what we're going to be looking at and basing our on the inflation side. And we want to get back to maximum employment. We still are, in spite of the pretty good labor market data we've gotten over the past several months, despite last month's little bit disappointment in that report, we're still making progress on the labor market side. But, right, again, supply issues are affecting those numbers too. And, we have to sort of continue on the path we're on until we get more people back into the labor market. And more progress towards our goals. So again, I think we're seeing this play out in both labor markets and product markets, and the Fed is just going to be focused on outcomes to see that, and recalibrate our policy appropriately to the outcomes.
What you're saying about the employment report, do you have a read on what happened there? Do you think that the enhanced unemployment benefits play a major role, as a lot of at least politicians think?
So I think a lot of things that are going on in the labor market still reflect some unease that we were talking about earlier in terms of re-engaging. And I also believe that and we hear this from our contacts all the time, the child care, school reopening, that is affecting the labor markets. I think people are making decisions based on those things, but the fact that they have the unemployment benefits gives them the financial wherewithal to actually be making those decisions. Whereas in the past, they may not have been able to make the decision they would like to be able to make because they didn't have the wherewithal. So in that sense, it's interacting. But I think the main drivers are these other considerations in terms of the virus and schools. And that's why I think we're going to see some of that downward pressure on labor supply abate too over time, because I think as schools reopen, as people get more comfortable with the vaccinations being widely distributed, I think people will feel more comfortable coming back into the labor market. And we're going to be watching for that. I certainly will be watching for that as we go through the rest of the year.
Let me ask you this. A number of people, including your former colleague Bill Dudley, the former president of the New York Fed, have been speculating lately that the economy could rebound more quickly and more strongly than people anticipated, and that by the time you get around to looking at actual realized data, you will have passed maximum employment and the inflation danger will rise, and then you're going to have to raise rates farther and faster than you thought. What's your view on that?
So I think, we are going to be watching very closely how the economy and the recovery evolves over the year as we get more data in. So, and we're guided by our dual mandate goals, progress towards those goals. So yes, there's, uncertainty around the outlook. There's risk around the outlook. Things could, pick up faster than we anticipate. Things could go slower than we anticipate. And we're prepared for that. I think we're in a good place right now with our policy, and we're going to adjust it as appropriate depending on how the actual recovery progresses. So that's why this is, not the time to really be adjusting anything on policy. It really is a time for watchful waiting, seeing how the recovery evolves, seeing how some of the supply constraints dissipate or not, seeing what happens on the labor side, and keeping focused on our dual mandate goals. So, I understand where Bill's coming from. I think the way I would say in response is we're well positioned now for upside and downside risks, and we're just going to have to be patient where we are now and wait a little bit longer, looking at the data to see where this recovery is going. But I have a positive outlook. I think the outlook is bright. I just think that we need to let it continue on a little bit longer. Because, opening up the economy after such a deep shock downward, right, is proving to be, there's some stumbles along the way. And I think we should have expected that. And I think that's what we're seeing in the data right now.
Well, let me ask you one last quick question. Do you think it's a foregone conclusion that when you finally talk about tapering, that you're going to get a taper tantrum, that the markets are going to try to reprice immediately and we're going to have a market disruption?
Well, obviously that would not be a good outcome. I think we've been very clear, and Chair Powell's been very clear, that we are going to be communicating well in advance what our policy stance is and where it's going. And my hope is that we'll be articulate enough and explain enough our rationales and our expectations that we will avoid the worst in terms of the financial markets. Volatility in financial markets is what financial markets are. We just want to make sure that, we're communicating as best we can our rationales and our approach to policy, and we'll just have to wait and see how well we do that.
Loretta Mester, the president of the Federal Reserve Bank of Cleveland, thank you very much for joining us this morning here on Bloomberg Radio and Television Worldwide.
Mike, always great. Fantastic, sir. Michael McKee there with President Mester. Always great to hear from President Mester as well. Tom, looking at the market right now, down about, up rather, by about 0.5%, down just a little bit off the back of those retail sales, but pretty steady following the report. And you made the right point, Tom. The previous month was just a monster.
Yeah,
March was just a monster.
The previous month was a monster. We begin to publish. Ian Lingen writes a very sharp note. John Ray says, look, the control group statistic dampens the calculation for GDP.
That was your call. That was your call.
I don't know if it was my call, but Ian says, look, here's the math, and the math starts out a little bit shaky, but he does emphasize that boom economy on that revision is extraordinary.
This was fun. I got a run coming up on the open.
Yeah.
The head of fixed income, multi-sector and strategy.
Why, he's not good enough for the real yield?
Greg Peters, he can't join today, so he's joining the open.
Oh, yeah,
he's busy this afternoon.
Why didn't we talk to
He's going for lunch with you. Greg Peters coming up a little bit later on the open. Coming up in about 20 minutes, actually, so looking forward to that conversation.
Very good, from full faith and credit over to investment.
You enjoy your long weekend, TK.
Oh, please, go
enjoy your Monday
off.
off.
Don't give me the happy talk,
I'll see you later.
Well, I hope Lisa comes back, or
so
you're going to solo on Monday.
Otherwise, I'll be on my own.
Yeah, okay. Well, have fun. Let me get on to our next guest because she is very valuable. There are economists that come on here and they warble gaily, and there are very few, like think John Taylor of Stanford University, who actually have a Bloomberg function. Claudia Sahm is one of our great thinkers, and she nailed the recession mathematics a number of years ago at the Fed, and there is the Sahm rule, which you can find on the Bloomberg, which shows a horrific recession of this instant pandemic, and then out we came to a better America. Except Claudia Sahm has said, wait a minute, the inequality that out there is tangible. Claudia, I want to get to the inequalities right now, and I want to get to what I'll say from John Edwards is three Americas. You got an elite boom. You got McDonald's and the rest of them telling us Amazon, they're going to hire low wage at a higher wage. And then there's the rest of America. How do we pull them into the dialogue?
Right. Well, this is absolutely the right question to be asking right now, because we have not in the past done a good job, policymakers, getting a recovery for everyone. Up to this point, we've seen a lot of messaging. We've seen a lot of actions by Congress with the rescue plan, the Fed with their new framework to say we're going to fight for those people to get everybody back, particularly those from minoritized groups. But like, we got to see it. And what you see right now are the other two groups, the elite, the wealthy, and the large corporations making a lot of noise that they need to be taken care of and not those at the bottom.
Claudia, within the three Americas, there's the idea of, yeah, we get back. We're going to be fully employed, 4% unemployment rate, whatever the number is. That math doesn't compute. If we have so many people left aside because of technology, because of education in the last 20 or 30 years, what's the program to actually pull them from a modern welfare state, however you want to call it, into an actual productivity for America?
Right. Well, our people are our most valuable asset, the thing that we should be investing in. And that's where, and our infrastructure, right? So physical infrastructure, invest in our people. We have two proposals going to Congress in varying forms. Like, there's so much we can do in terms of investing in people and families in the next generation and our physical infrastructure. Those are the kind of things we need to do now. Like, we have to fight this recession, but it is not good enough to get back to pre-COVID, because pre-COVID, there were a lot of problems. And frankly, our productivity as a country had slowed down. I mean, we were all suffering, and some were suffering even more. And we can fix that with good policy and a lot of push from markets too. I mean, the private sector has a big role to play also.
Claudia, the complexity of productivity, and I really try, Claudia, on a Friday not to talk about productivity, but I'll dive off the deep end here. On productivity, it is about this strange MIT solo word, technology. Are we less productive because we're overwhelmed by not the negative, but just the realities of our modern technology?
So I don't want to paint that dark of a picture. I will say, you know, productivity is the sum of what we do not know, right? It is very hard to measure. It's very hard to really say where we're at and why it's slowed down. But we do know that education, helping workers have stable lives, economic security, job ladders, right? Like, it's not, even if we can't see it in the GDP data, like, that's real. That matters to people. So I don't want to, like, technology has always been with us. Automation's always been with us. That's not an excuse to throw in the towel here.
Claudia, you're every Republican leader's worst nightmare. They won't talk to you. They hang up the phone. They call, hello, the Jane Family Institute, but we don't want to talk to that wacko economist Sam. Okay, but are the people of the Republican Party in sync with their leaders, or do you buy what's percolating in Washington, that President Biden can get societal support of Republicans, even if he doesn't get the leadership support?
Yeah, well, I will say I talk to Republican voters every day, that being my parents.
Really?
Wow. Yeah, no, I grew up in Indiana. I'm not a political person. I do think we need to have policy and an economy that works for everyone, but frankly, that is not, like, that's what everybody wants in the United States. There are big debates about how to do it best and what the role of government versus the role of individuals are, but I think this is one where the politics that are just crushing work in Congress and the administration and have for decades, this is a real disservice to the American people. And I try and stay in my lane on the economics and not the politics, but it's hard to watch.
It's a break exclusive, folks. It's a surveillance break exclusive here this morning. Claudia Sahm speaks to members of the GOP. It's an extraordinary moment. Claudia, I want to go back to University of Michigan, where you took your PhD. It's really been one of our hotbeds of inflation research. What is your observation on the fear, the worry, the angst, the pendulum of inflation?
Yes, I feel like we all just got to step back and take a deep breath, right? There's been way too much attention to the last set of data points, whether it's jobs or inflation or today retail sales, right? We have a $21 trillion economy. We have really tried to push it intentionally to get people back to work and back on track. This is exactly what we said was going to happen. Right? Like, you can't get all excited about historic forecast miss or like numbers that come in bigger than we thought, because this worked like the entire last year. I mean, remember last year, they were all way worse than we had expected, right? So I think we're losing context, and I get it. It's scary. It's uncertain. But if you look at, especially I look at the consumer expectations numbers, I mean, people, they don't like inflation. This is true, but they will tolerate it to a moderate level, like 2%, 3%. This is not, as long as wages are rising. But what is really, really hard is not to have a job.
Very quick.
Right, so we have to keep it in balance.
I'm running out of time, Claudia, but very quickly here, is the argument of corporations that they've got to pay $16, $17 an hour going to overwhelm the Deep South that wants to pay $7 an hour?
So there's going to be a lot of adjustments in the labor market coming out of this. Again, we're a dynamic economy, and it's so different across the country. But right now, there's a lot of talk, and we just have to, I mean, these are business decisions. This is not something we can fine-tune from Washington, D.C.
We've got to leave it there. Claudia Sahm, thank you so much, with the Jane Family Institute and their senior fellow today. Next week, we've got housing. I really want to focus on that. And, of course, that's been on fire. Thanks to Mitch Rochelle for joining yesterday. The data, well, you know, it's been churning all morning. As John mentioned, off soggy retail sales. We come back a little bit, but futures up 25, and the VIX comes in 1.66 points, 21.48. What's really important is the weekend news flow. We will do that for Bloomberg worldwide, and we start strong this morning. This is without question our conversation of the day on what is going on in Israel. David Weston and Balance of Power in conversation with Martin Indyk. You don't want to miss it. Ambassador Indyk has a extremely nuanced perspective on the domestic politics of Israel, and for that matter, the Arch of the Levant from Turkey down to Egypt. That will be an important conversation at 12:30 today. Please stay tuned on television. I believe a property of John Farrell's coming up. Paul Sweeney and I will join you on radio. Good morning.
Have you ever thought of bottling your happiness? And you know, you could make a lot of money if you bottled your happiness.
Yeah, you know what it is? It's just gratefulness. I should have died in that field in Iraq.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York City, for our audience worldwide, good morning, good morning. The countdown to the Open starts right now from a beautiful New York, with equities up 0.6% on the S&P 500. We begin with the big issue, struggling to gauge the incoming data.
The reopening trade has accelerated.
Fear has dissipated.
You're looking at, post-pandemic era.
Removing the masks is, I think, symptomatic of that.
We are transitioning as we enter this new phase
from a spring bloom to a summer boom. We're having this surge in economic activity right now.
There are some nuances.
So much uncertainty. We have pent-up demand.
Meaningful concerns about inflation.
There's huge anxiety about inflation.
Intersecting with pent-up saving with a reopening.
We're seeing a pretty major shift in the supply-demand dynamic.
Things that were denied to us, entertainment, travel, restaurants, are now open.
You have to recalibrate. There's pretty powerful forces.
Some pretty powerful forces. Let's bring in the team. PGM's Greg Peters, and from UBS, Leslie Falconio. Leslie, let's just start with the incoming data. Another miss for economists. How difficult is it to gauge the incoming data at the moment?
Well, I think you can't go data by data point. I mean, obviously, what we've seen, there's a lot of noise within this data, from what happened with non-farm to today's retail sales. But I do think overall the economy is growing, which is important. I think that a lot of this in terms of the retail sales number is just that the fiscal stimulus was front-loaded to the first quarter. And that's why we had this sort of mantra of cheaper and steeper in the first quarter, and the reason why 10-year yields got to 177. But we expect a lot of volatility within this data, and there's a lot of noise within the data, but the trend is still the same, that the economy is growing.
What's your take, Greg?
I completely agree. I think we're making too much of each and every data point. The misses are going to be kind of unprecedented just by virtue of the fact that, we really haven't seen this experience before. But I think you have to focus on the trend. And the trend is clearly strong. And I think that's what really matters, not whether it's off by 0.2 or 0.6 when you're looking at such a big absolute number.
Do you think this is the struggle at the moment, though, Leslie, that we got used to, conditioned by the previous cycle where growth levels were pretty low and stable and the data, relatively speaking, was pretty predictable? Is that the struggle here at the moment?
I think it is. I mean, I think there's this fear. There's a fear of the unknown, too. And when you look at it, particularly within fixed income, it's not as though there is a huge opportunity set when it comes to relative value. And this unknown and this volatility within the data is, causing a bit of concern. But with that said, it's interesting. When you look at the actual treasury yields, and today's a perfect point. I mean, you barely moved. So I do think we're going to be this range bound for quite some time. But the fear is when you're not. And that is the unknown that I think is a concern to the market.
Just moments after we got that retail sales print, we got the reaction from the Federal Reserve. This is what Cleveland Fed President Loretta Mester had to say just moments ago.
My baseline scenario for inflation is that we're going to have higher inflation this year, above 2%. But then as some of those constraints on supply ease, I think we're going to see inflation go back down, and we'll have to, monitor that as we go forward.
Sticking to script, talking to Michael McKee a little bit earlier. I want to turn to Michael McKee up in Boston, our international economics and policy correspondent. Mike, no real changes here from the Federal Reserve after a week of data.
No, and they're all looking at it as, everybody grab your glass, transitory. Because they don't think that these kinds of changes that we have seen, both in the labor market and in the prices, are going to continue. They have a sort of explanation for each of the things that has happened. And you can see it again in the retail sales numbers today. They were, as you mentioned, a bit of a surprise, just flat on the month. But when you look at the dollar value, and retail sales are reported in terms of dollar values, we don't see a huge inflation impact, but what we do see is there was only a small change in the amount of retail sales from March to April, but from February to March and April, there was a big change. So basically, people are spending the same amount of money, still spending the stimulus checks, just not a greater amount, which is certainly no surprise given how much they spent as soon as they got those stimulus checks.
Mike, a little bit later this morning, we get the University of Michigan data, and I just wonder how important the inflation expectations component of that is going to be in the next few months.
Well, it's going to be very important. The Fed knows that Americans don't have a real clear picture of the economy and inflation, so they're not going to look necessarily at the numerical change if it goes up or down by a couple of basis points, but they are going to look at the direction. And if it stays flat, if consumer expectations for inflation stay flat, or even if they go down, that's going to be what they want to see. They don't want to see a breakout to the upside. They're also watching, obviously, what's going on in market rates. And as Loretta Mester was talking about, those have remained steady because you get a jump in the short-term futures, but you don't see that in the longer term. 2 years inflation is much higher than 5-year inflation, and 10-year inflation is much lower than both of those. So the markets expectations aren't unmoored either.
Mike McKee, thank you, sir. Greg Peters, I want to turn to you. The incoming data is always something to confirm your priors. The confirmation bias is something that I think grips every investor to a certain degree. And I'm wondering, Greg, from your perspective, your standpoint, of the economic data that is incoming over the next few months, what you will be focused on?
Yeah, what I'm focused on is what's under kind of the Fed control and mandate and versus, what's not. And so I think this whole transitory speech kind of misses the bigger point, which is, I think most of these factors are outside the Fed's mandate or abilities to control. They're exogenous in nature. And so when you're looking at the supply chain issues, you're looking at the labor shortage, these are things that the Fed can't control or cut kind of those inflation fears. So I just feel like the market is somewhat missing it here. They're focused on the wrong thing. We should be focused on the items that are outside the Fed control, because I think those are the things that ultimately are going to allow the economy to grow in a more sustained way.
Greg, I'll come back to you on this point, but Leslie, I think the point that people have is, okay, if there's supply side issues, the Fed has no role to play here either way. So why is it sitting here and carrying on juicing the markets when we don't have a demand problem? We have supply side issues. What would be your reaction to that?
Well, I mean, I think it's a little bit too soon to tell in terms of whether or not they should be pulling back on, QE. I mean, I'll tell you from our view, we don't think they do this year. I mean, they might announce at the end of the year, but there's a lot of volatility within these numbers, and they really need to wait till after some of these, employment subsidies, schools open, and people feel a little bit more comfortable in terms of COVID. But one thing that we are watching, which, is somewhat of a point of concern, is that when we look at real yields and how negative real yields are, that is something that we do watch, because if break-even inflation expectations and real yield should be rising in parallel, maybe not the same percentage, but they should be rising in parallel. And as real yields rise, financial conditions tighten. But the fact that real yields are staying so negative is definitely something that we're watching.
Greg, your real response to that, real yields, break-evens, and how distorted those markets are. I think what interests me at the moment, at least, and I think others too, is people look for break-evens and they try and find some nice, neat gauge of inflation expectation. Does it actually offer that?
Not necessarily. I mean, it is correlated, but there is a premium built into the break-even market, right? It's just uncertainty, if you would. But I think the most interesting part about the break-even market, as you described earlier, is that it's declining over time. So, the market's telling you that inflation concerns are more near term than longer term. And I think that's quite appropriate. But the real yield, like you showed, Jonathan, is critically important here. And the fact that you've seen real yields dive lower is tremendously supportive for the market. The challenge, of course, is if it dives too much, then it kind of goes the other way, and we're not quite there yet. But it's financial conditions are extremely easy here.
So, Greg, I appreciate the plug for the show, 1 p.m. Eastern Time on Bloomberg TV, for anyone interested. Before we get to that, Greg, just finally, do you think everything you've just said is really supportive of credit? You're sticking with that trade, there's nothing to worry about, no reason to be concerned?
Well, the challenge that we have with credit is really the valuation side. So spreads have really compressed meaningfully, quickly. So I don't think there's a lot left in the credit trade per se. And I think it's more acute on the investment grade side of the aisle. So I still think there's some room for high yield, given the fact that it's high beta to the economic reopening and recovery. Whereas investment grade corporates, what you're seeing is share buyback activity, other type of M&A, things that are balance sheet destructive. So I don't think the credit trade's over, but I don't think it's the macro dive-in type of trade that it once was.
Leslie, we'll come back and continue this conversation. Just wanted to give you the final word here. Your response?
I mean, I agree. I mean, I don't think the credit trade is over, but I think it's going to be now about carry and not spread compression. I mean, we've seen a huge amount of tightening in the CCC sector, which one would expect, in the beginning of the cycle. But that's played out a little bit. So, I think that in terms of high yield and loans, which is one of our preferred asset classes, you'll get a lot of carry there. And I don't expect it's going to see a lot of spread compression. When it comes to the IG market, that's a different story. I mean, we don't want to take on a lot of interest rate risk here, so our preference for IG is not large. I think that all credit is fundamentally sound. We just don't, our return expectations going forward is definitely mitigated to more towards carry versus spread compression.
We'll continue this conversation. Leslie Falconio, Greg Peters, thank you. In your market, futures positive. With your movers, here's Abby.
Stocks are positive, futures are positive, John, for a second day in a row. In fact, the S&P 500 headed to its second best, or its best 2 days since late March after 3 brutal days. Not a piece of the action, though, Disney. Shares are lower in the pre-market. This, of course, after they missed the streaming subscriber numbers, coming in a little better than 103 million versus the estimate of greater than 110 million. And similar to Netflix, it has to do with a lack of new programming. What is working, though, big tech. We have $6 trillion, more than $6 trillion worth of market cap in the green. Apple, Microsoft, Amazon, Alphabet. Investors looking past valuation concerns as yields fall. Interestingly, even with yields falling, not by a lot, but the 10-year yield is down about 2 bips. We do have the big banks climbing, so the reflation trade, or the cyclical trade, I should say, is working. JP Morgan, Citigroup, other big banks working, climbing higher. And the one sector to drop yesterday, energy. Oil's higher. Big energy stocks are higher in sympathy with oil, so lots of key sectors working. Disney, not so much.
Abby, thank you. We'll pick up on Disney later in the show. Coming up on the program, getting back to normal in America. The CDC announcing a pivotal shift in guidance. That conversation up next with PGIM's Greg Peters and Leslie Falconio of UBS. 20 minutes away from the opening bow, call it 19. Your equity market up 26. We advance 0.6%. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vows in a digital future.
Come on, John, I just think it works.
It works. We're
beating this to death.
Watch weekday mornings on Bloomberg Television.
Anyone who is fully vaccinated can participate in indoor and outdoor activities, large or small, without wearing a mask or physical distancing. We have all longed for this moment when we can get back to some sense of normalcy.
It's a major turning point in the fight against the pandemic. The CDC announcing fully vaccinated Americans can ditch the masks. President Biden acknowledging the milestone while urging Americans to remain diligent.
It's a good day for the country. There's still more work ahead. But I've said many times, as tough as this pandemic has been, we will get through it. We will rebuild our economy, reclaim our lives, and get back to normal.
The President of the United States. Let's bring in Bloomberg's Kelly Lyons for more. Hey, Kaylee.
Hey, John. Well, this really does feel the kind of new day in America type of vibe. So many of us have been waiting for the day we're told it's safe to take our masks off. And for vaccinated Americans, in most cases, that is now true. There are exceptions to the rule in the CDC guidance, John. They are still encouraging people to wear masks on public transport, on trains and airplanes and hospitals, etc. And businesses and localities can still make their own rules. Also, this doesn't apply to anyone that isn't 2 weeks out from either their single-dose Johnson & Johnson vaccine or their second shot. You have to be fully vaccinated. And that is a key part of this conversation, John, the idea that this is incentivizing those who haven't gotten their shots yet to do so. To this point, about 267 million doses have been given across the United States, and that has helped the curve slow down dramatically when it comes to U.S. COVID cases. But progress is slowing down a bit. Demand for inoculations is waning. Over the last week, the current pace of inoculations was about 2 million per day. That's down from more than 3 million at one point. So you need to make more progress in order to get closer to that herd immunity goal. And of course, a lot of that conversation, John, is going to depend on getting younger people vaccinated as well. Those 12 and above can now do so with the Pfizer and BioNTech vaccine. So that will help with the herd immunity equation and help get the U.S. higher globally speaking on the vaccination front, John.
Companies have got to work out what they're going to do with their mask policies, haven't they? Kelly Lyons,
yes.
Thank you very much. I'm sure they'll work that out pretty quickly. Greg Peters and Leslie Falconio with us still. Leslie, this is a US-centric story. I think it's easy to be seduced by the idea that we're almost through all of this because here in America, it feels that way. The rest of the world, that's not the case at all. What does that mean for your approach to the global economy and to global fixed income, given this very sort of fragmented way of reopening this economy, globally speaking?
Well, I mean, I think there's parts of globally, such as Europe, that's getting a bit better in Germany. And we're seeing this, when you look at the 10-year German bund, the rise in interest rates. And in our view, in terms of Europe, is the second quarter, it should get a bit better. I mean, obviously, they didn't have the success of the vaccine rollout that we did have initially, but they're getting there. So I think there's always going to be pockets of vulnerability along the way. But it's definitely more of a second half story when we look at different regions.
Been looking at a German 10-year creeping all the way back close to zero, negative 13 basis points. Yields coming in just a little bit today, but before that it was 7 straight days of just climbing, inch by inch. Greg, how important is that development in Europe at the moment? Yields coming back just a little bit more.
I think it's important. I mean, it speaks to stronger data on the come. It's been kind of a long, hard road, have underperformed kind of relative to expectations if you go back 6 to 9 months ago. So I think this is quite welcome. But it's also important to keep in mind that there's a level where they kind of stop out and we're getting close because at the end of the day, the ECB controls the policy rate and is still decidedly negative. So I don't think there's a lot of scope for it to move much more, but I think the move itself has been important and speaks to the bigger repair story across Europe.
You said it was welcome, Greg. I just wonder if the ECB shares that enthusiasm. The Federal Reserve said what they saw in the Treasury market through March was consistent with the outlook, improving high yields. Do you think the ECB will share that view, given not what's just happening in Italy, but in Germany and Italy as well?
You know, I think that they'll share the view on the growth front. But I think it's interesting that inflation still is quite anemic there. It's not picking up the same way that we're seeing here in the U.S. So they still have a disinflation issue. I'm just not convinced that having decidedly negative yields help that along necessarily. So, you know, the ECB, sometimes it's confounding, but I do think that it should be welcomed by them as well. At least I hope so.
Are you anticipating any pushback whatsoever, Leslie?
No, not at all. I agree with what Greg said. I mean, I think they'll continue with being supportive, and I think the most important thing that Dave mentioned too, there's really not a lot of inflation in Europe, so I think that's definitely more supportive for them in at least over the short term.
So let's get to the bond call. I want to understand when you both become buyers of this market. And Greg, I know that you've been a little bit tempted by a yield through 170 in the past. We did that a little bit earlier this week. We did it yesterday, in fact. What is the approach to duration and the process you go through, Greg, to decide whether to add it?
Yeah, so we think we're largely done here. My view was that it's hard to be kind of max long rates with the data coming in so strong. I just think it's human nature and psychology. But I think the rate move is largely finished here. So we're still pretty constructive on interest rates. We think the curve will flatten. I think there's pressures around that happening over the near term. But I think the near term is really difficult. I think longer term is easier, as we see lots of opportunity in treasuries over the medium to long term. I think rates are too high, and the natural rate is lower. And once we get past this burst of activity and inflation, there's lots of value in the yield curve.
Greg, let's just repeat that. 10-year 163. You think we're A, done here, and B, that rates are too high?
Correct. That's right.
Leslie, your reaction to that?
I don't think rates are too high. I mean, we came into the year, bearish. So there's no question the volatility or the velocity that interest rates rose in the first year was not what we were expecting. But we came into the year bearish. And now I think we're going to be range bound at 145 to 175 for some time. But we do expect interest rates to rise into the end of the year. I mean, not materially, maybe around that 2% level or where we were in the fall of 2019 pre-pandemic. I mean, but one of the things that we do watch for and are looking at is the 5-year forward, is higher than the long-term terminal rate. So we are paying attention to those kind of indicators, but we do think interest rates rise, but not in a material fashion, 2% by the end of the year.
Leslie, always great to get your perspective. Enjoy catching up with you. Leslie Falconio there, and Greg Peters. Greg Peters with an outlier call together with the team at PGIM on this bond market. Guys, thank you. The idea that A, we're done here on a 10-year, and B, rates are too high. Leslie, pushing back a little bit. Your 10-year, 163, coming in 3 basis points after that retail sales miss. Your 30-year comes in 3 basis points to about 236 on the day. Coming up, the morning calls and later, retail in focus as we look ahead to earnings next week. That conversation still ahead with Citi's David Balin and Jack Manley of JP Morgan Asset Management from New York City this morning. Good morning. We're about 8 minutes away from the opening bell in New York City. We're going to have a lovely weekend, apparently. Futures up 27. We advanced 0.7 of 1%. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
About 6 minutes away from the opening bell in New York City. Equity futures are coming down, up rather, about 28 points. We're up about 0.7%. We're down on the week, though, by almost 3% coming into Friday. From New York this morning, good morning. We have had a hat trick of misses on the economic data. Downside surprise on payrolls, downside surprise on retail sales, upside surprise on CPI. Not exactly the greatest mix for this market. This Friday, though, we look okay. Nasdaq futures up a little more than 1 percentage point. Over in Europe, the FTSE up 0.8. The DAX, the equity benchmark in Frankfurt, Germany, up 0.9%. If we switch up the board and get to the bond market, we'll take a sneak peek of treasuries for you. Your 10-year yield comes in 3 basis points to about 163 on a 10-year. The range, you know the range, you're familiar with it. Intraday, the recent range, last Friday, 146 was the low of the session following that big disappointment on payrolls. Yesterday, the high of the last week, intraday, just north of 170. Just settling down somewhere in between at the moment. In the FX market, the story is clear. Throughout the whole this morning in the G10 space, the dollar is weaker. Euro dollar out to about 121.37. Dollar yen coming into 109.32. Norwegian kroner doing nicely. Crude no doubt helping out that cause. Crude this morning, WTI at 1.5% to 64.79, just short of a 65 handle. That's the price action. Here are the morning calls. Some of the analyst action you need to be looking at this morning. We begin first up with Morgan Stanley reiterating its overweight rating and $900 price target on Tesla. The analyst recommending using the stock's recent weakness to increase exposure. Next up, Citi, resuming coverage on GE with a buy rating and street high $17 price target. The analyst seeing material upside stemming from increasing demand. That stock up 1% and change. And finally, Goldman, upgrading AMC Networks to neutral after earnings. The analyst seeing improving linear trends and subscription video on demand growth. That stock unchanged. Up next, retail sales stalling ahead of a busy slate of earnings next week. That conversation still ahead with Citi's David Balin and JP Morgan's Jack Manley from New York. 4 minutes away from the open. That's next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
23 seconds away from the opening bell in New York this morning. Good morning. 23 seconds away with an equity market down on the week by 2.8%. Potentially the biggest weekly loss since January. We're set to erase some of that at the opening bell. There is your opening bell. Up 0.6% on the S&P. Switch up the board into the bond market we go. Your 10-year yield coming in 2 basis points to 163.52. Euro dollar 121.34. We're firmer there by 0.4%. The dollar is weaker and crude is higher, up to 64.84. We're up 1.6%. That's the cross-asset story this Friday at the market desk with your movers. As always, here's Abby.
John, let's start out with some earnings and related stories. Of course, Disney is the top story relative to earnings. The shares are lower. This, of course, after their streaming subscriber numbers missed, coming in greater than 103 million versus the estimate of up 110 million. New content thought to be the problem. On the other hand, Plug Power, which restated their results for the past 3 years, an overhang has been removed. That stock is soaring up 15%. And Airbnb reversing an earlier loss, up 1.8%. Strong results with bookings growth better than the estimate by more than 40%. Turning to what's really moving the market, though, John, if we take a look at big tech, Apple and Amazon both climbing for a second day, a bit of a rebound. The dip buyers out once again from those 3 down days in the beginning of the week, helping to create the weekly loss. But again, we have green here, and another piece of it, we really have the Bitcoin space rebounding after a roughly 10% 2-day slide. Bitcoin is higher, taking the crypto space with it, John.
Abby, thank you. Leading the way is energy today, up 1.8% on the S&P 500. Early days, crude higher as well going into this. We're up 0.8% on the S&P 500. Pull up the Walt Disney stock just quickly. We're down about 3 percentage points in the early part of the session. As Abby mentioned, a lot of people talking about the content slate, the underperformance there. Disney at 172.43. I caught up with Michael Nathanson and MoffettNathanson, and we just talked about content across all the platforms. Netflix, the Walt Disney Company, and the pull forward dynamic of last year. How many people do you know that are looking around right now after spending $10 here, $15 here, $10 here on a range of services through last year, and wondering whether A, they need them, the ones they already have, and B, whether they need any extra ones either? That stock is lower by almost 4 percentage points around the opening bell. Elsewhere, the rotation into value gaining some momentum with the reopening process accelerating. RBC's Laurie Calvasina seeing signs of continued outperformance.
We see inflation expectations move up. As long as the underlying economic backdrop is still doing just fine, it should power financials and it should power that value trade generally. We're going to have, some interesting days, but the runway is there from an economic perspective for this rotation to keep going.
Let's bring in Bloomberg's Kelly Lyons for more. Hey, Kaylee.
Hey, John. Well, the rotation certainly has already taken shape so far this year. You know the story from a sector perspective within the S&P 500. At the bottom of the barrel, you have tech. On top, materials, energy, financials, all of those cyclical and value plays. And when you look at the individual movers that have topped the index on a year-to-date basis, 2 of them are tied to commodities, a material stock, Nucor, an energy stock, of course, Marathon Oil. The other 2 are retailers. L Brands up the better part of 80%, Gap by about 70%. Both of these stocks up 500% from trough to peak. So this is what the setup is ahead of retail earnings that really kick off next week. L Brands, one of the companies that will be reporting, but Walmart really kicking things off on Tuesday. And there's a couple of questions these retailers are going to have to answer, John. First of all, what is the forward demand picture looking like as we see the effect of fiscal stimulus waning? That is what showed up in the retail sales miss earlier today. The other question, are they able to exercise pricing power and pass the cost of higher input prices on to their consumers? Of course, we've already seen a number of consumer-facing companies do this in the staples space. It'll be interesting to see what the retailers have to say. And we already have seen higher prices showing up in the CPI data we got this week. We had men's apparel up 2%, footwear up by 4%, and John, jewelry and watches up 9.5% year on year in the month of April. And that helps explain why you've seen jewelry and watchmakers specifically on a tear, an index that tracks them up the better part of doubling over the last year, up 95%. That is double the gains we've seen for both the retailing index and the S&P 500, John.
Men need to buy suits again. And ties. We need to bring the tie back. And watches, apparently. I don't know about watches, but ties need to come back. We're sick of seeing that. At least I am. We need to keep the tie in there. Katie, thank you. Richmond Fed President Tom Barkin betting on a strengthening consumer. Take a listen.
Spending's come back faster than employment. We are already seeing a really strong spring and summer. Excess savings and fiscal stimulus are funding pent-up demand from consumers who are exhausted from isolation and freed up by vaccines and warmer weather. You already see this in the data. Consumer confidence has skyrocketed.
It is skyrocketing. Citi's David Bailey and JP Morgan's Jack Manley joining us now. David, let's start there. The data has been confusing over the last week. Are you still pleased with what you see in the underlying trend of things?
Absolutely. I think that focusing just on, these point-to-point data, looking at inflation, et cetera, is actually somewhat misleading. Looking at the retail data, misleading. We have to look ahead 6 months. We're having an economy that's reopening. So, for example, take a look at the price of tickets on airlines, right? They're up 10% in 1 month. We can say that's inflationary. It's also demand of people getting out of the house and the fact that there aren't enough planes coming back online. When we look out just 6 months, we're going to have all the planes that we need. All the restaurants are going to be open, given the CDC's announcement. All of this, change from what you would call stay at home to leave your home is going to take place. And you saw that, you just mentioned it, in terms of Disney and in terms of streaming. We're in the midst of that change. But when we look at this data-driven wise and in terms of what people's intentions are, what we're seeing is an incredible pent-up demand for certain parts of the economy, and basically anything that leaves your house. And in our mind, that plus the fact that we have all of the savings is going to cause the economy to continue to grow at between a 6 and 7% rate for the next year to year and a half.
David,
that's particularly.
You mentioned that supply-demand dynamic, though, and what I'm trying to figure out, and everybody else is too, is the price that we have to pay to solve that demand-supply imbalance through the rest of this year. Did you just assume it's a higher price, or is something that's settled with time?
Let's take a look at what's actually happening with commodities. We talked about that, right? Commodity price high, and there's scarcity and shortages of everything from semiconductors to dishwashers, right, and certain cars. These supply chain things will resolve themselves, and when they do, regular pricing will actually, come back. And so right now, at this moment in time, there is a premium to be paid for goods that are in short supply, and that premium is temporary.
Do you agree it's temporary, Jack?
I agree generally with what David had to say. I do think that a lot of the forces impacting inflation right now are transitory. I think that demand is going to stay elevated longer than supply is cut short, but even that should start to fade as some of this stimulus rolls out of the system. The one thing that we are starting to pay a little bit more attention to, and this was made evident in last week's employment report, is the fact that wage growth does start to be picking up, a lot of that having to do with this latest round of federal government unemployment insurance. A lot of people being disincentivized to work and actually staying on the sidelines. And how do you get people back into their jobs? Well, you're going to have to pay them a little bit more. And whereas the supply issues are temporary, the demand issues are temporary, I do think that wage growth, if we start to see it materialize in a more meaningful way, that is a bit stickier than some of those other forces out there.
So you think there's some margin risk through the year, Jack? And where is that margin risk more acute as you look through the equity market?
I still believe in this value trade. I still believe in the cyclical trade. I think that, as Lori mentioned in some of those introductory remarks, there is a long runway when it comes to the economic backdrop. The consumer is extraordinarily healthy. There is all this pent-up demand. The weather's getting better. The per capita vaccination rate can only move in one direction. And we've noted that value stocks in general are much more levered to higher U.S. growth. They're highly correlated to greater inflation. And when I think we pick apart that value story, to me, and you've heard me say it before, John, but to me, still the best thing out there is going to be that financials play, especially if the yield curve continues to steepen.
Let's pick up on the banks. David Baden, yields 160-ish on a 10-year. PGIM's Greg Peters on the program with me 20 minutes ago, who said he thinks the move is done. We've seen the highs. This is it. Rates are too high, even at 160. If we are done here, David, what would that mean for the banks?
I respectfully disagree.
I think we're going to
see. I think we're going to see the 10-year at close to 2% by the end of the year once all this stuff is baked in. Remember, we were at 190 before the pandemic, and we're not sure why rates should stay down where they are now. Given this, we think the bond market is actually late to the game, and so we think that is a headwind for some technology stocks and others. But for financials, I think this is a particularly great time. There are some other areas in the market that are really good values as well. Another mean reverting trade will be in emerging markets, and certainly financials within emerging markets, some of the values plays within emerging markets. Right now, the discount is very significant. Same is true for healthcare relative to technology, where we think there's a lot that can be picked up. And lastly, John, ties. People haven't been wearing enough of these, and we recommend that people go out and buy their tie right now before the demand takes hold.
I am so pleased you're on board with that, David Baden. You've got to put one on. Jack Manley turned up with one. The three of us have got to be wearing ties after the commercial break. Stay close, won't you? We'll continue this conversation. Want to head back to the market desk and get your movers. Here's Abby.
John, here's a blast from the past. AMC Entertainment, remember that one? Well, it's actually up 6 days in a row, the longest winning streak since July of 2019. This on the Reddit traders being back out there, but Wall Street also backing the fundamentals. B. Riley saying that the company has balance sheet strength. However, it also has a piece to do with the reopening trade and the idea that with the CDC relaxing the mask rules for fully vaccinated people might be going back into the movie theaters. We see that too for the cruise operators and the airlines. Lots of strength here for the travel industry. And then rounding it out with the department stores, despite the retail sales miss, we have strength for the likes of Macy's, Nordstrom, and Kohl's. The prospect of being able to go out and buy ties and being able to perhaps do it without masks, again, for those who are fully vaccinated, John.
That's great news. We've still got to work out this travel business, Abby, because this is still a mess. I think it's so confusing going into summer where you can and can't go. I don't think people can plan. And if we can't plan, how on earth do the airlines plan for capacity? And I know they've been complaining about that again this week. Coming up, the GOP preparing to offer President Biden a counteroffer on infrastructure. That conversation's still ahead with Citi's David Baden and JP Morgan's Jack Manley from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Very, very good meeting. I am very optimistic that we can reach a reasonable agreement. But even if we don't, it's been a good faith. There's a good faith effort that's been started.
The president yesterday keeping an open dialogue with Republicans on infrastructure. Republican Senator Pat Toomey sounding optimistic about a potential deal, saying the following: Congress and the Biden administration can come together and enact a bipartisan bill that responsibly boosts federal support for our roads, bridges, ports, and airports. Let's join Bloomberg's Emily Wilkins down in D.C. now to catch up and ask what on earth is going on, Emily. I asked early this morning whether the talks had stalled somewhat. Are we making some progress here?
I mean, from what we were hearing from the Republicans who were in these meetings with President Biden, their answer is yes, that they actually started discussing some of the more difficult questions about how exactly they were going to pay for this bill. They started to talk about potentially public-private partnerships, looking at other options besides raising the capital gains tax and the corporate tax, which Republicans have been adamantly against right from the start.
I'm assuming the taxes won't be involved in these negotiations because Republicans have said they're a red line. Do you see, though, some progress being made in separate negotiations between Democrats to just go their own way and include the taxes?
There's definitely been pressure from Democrats, particularly the progressive wing of the party, for Democrats to just go it their own here. They're saying that they want to make sure that they are delivering a large amount of relief for the American people, that they're really getting big programs done. They see that as the key to them winning in 2022 is for them to really deliver here. And so you've seen progressives like the head of the House Progressive Congress, Congressman Pramila Jayapal, come out and say that the House should just pass it via reconciliation, that they shouldn't be negotiating with Republicans when they already have the votes to pass it via reconciliation. The question, of course, is what can or cannot be done via reconciliation. As we saw with the $1.9 trillion coronavirus package, there were some key things that were left out. It was the minimum wage. It was several specific transportation and infrastructure projects. And so there's this balance here as far as what can or can't be done under reconciliation.
Emily, just finally, cyber as a theme, a bigger theme this week, that's for sure. Involved in these talks now?
There are definitely discussions going on Capitol Hill about this topic, and we expect them to continue to go on for the next several weeks. I think we're going to be hearing more, and we're definitely going to be paying attention to what lawmakers have to say.
Emily Wilkins, as always, paying attention down in D.C. Emily, thank you. Still with us, Citi's David Balin, JP Morgan's Jack Manley, back with us on the infrastructure talks down in Washington, D.C. Jack, it's hard to get your hands around how big the packages will be down in Washington at the moment. Do you have any base case assumptions right now? Because I was looking at some forecasts for next year from the likes of Jonathan Golub at Credit Suisse, and as they look out to next year, they are thinking about a move on taxes, corporate taxes from 21 to 25. Any assumptions that you would make as a base case looking out to 22?
So I would say, you know, the issue with taxes right now, the issue with this broader spending package in general is that I don't even think President Biden really needs to worry too much about congressional Republicans, because a lot of what can get done or what he wants to get done can be accomplished through that budget reconciliation process. That said, he does not have a guaranteed 51 votes in the Senate even to raise the corporate tax. There are certain Democrat senators out there that are going to take a pretty firm stance on not being willing to raise tax rates, at least not that high. So we do think of something closer to that 25% as being more or less the base case. We also recognize that infrastructure spending, especially physical infrastructure spending, is a bipartisan issue, and it has been a bipartisan issue for some time. So that portion of the bill seems much more more likely to make its way through Congress than the quote unquote human infrastructure package that we've also seen proposed. And we have to pay for this one way or another. So, John, I keep thinking when I talk to clients, we really have to start thinking about higher taxes as an inevitability, not really a question of if, much more of a question of when.
Interesting. David, talk to me about how your thoughts, your base case has evolved over the last few months.
So this is a package that is highly likely to be passed through reconciliation. Even though these negotiations appear to be useful, it would require really two different bills. One, where the Republicans and Democrats would agree on infrastructure, and the second, which is almost a certainty to be passed through reconciliation, would be the bill having to do with human capital. So I think higher taxes are definitely on the horizon for both corporate and individual payers. That said, again, one of the analyses that we've done is that we don't expect that this will necessarily derail the recovery either. And the taxes are going to be focused predominantly on wealthy taxpayers, right? And it will impact certain industries more than others, one of which is technology, creating a second headwind for the sector, one of which, as we talked about, is interest rates. The second is the likelihood of higher taxation. So again, this talks to what portfolios should have in the future. And John, one of those things has to do with this idea of developing a portfolio of leaders, right? Companies that in 2022 and 2023 can actually lead both in revenue growth, market share, and earnings growth. And that's really, I think, where portfolios are going to have to rotate over the course of the next 6 months.
How do you identify them, David? What's the process?
Yeah, that's a great question, and it's something we're involved in across